All right. So the 2025 A-level discussion, starting off with the first question, company account. So here we have Janaka PLC. It's a manufacturing company that produces a single product. The company was incorporated on 1st of April 2024. The drafted income statement of the company for the year ending 31st March 2025 is given below. So it's a new type of a question. First of all, it's a newly started business. They have started the business during the year, 1st of April 24, and the year is ending on 31st March 2025. And also, they have already calculated the profit, okay, by preparing a drafted income statement, which means the value could be wrong, right? Drafted income statement. That means they have temporarily calculated the profit for the year. Okay, so we will have to correct it all of it will not complicated. Then the summarized trial balance as at 31st March 2025 after preparing the draft income statement is also given. Okay, there's a summarized trial balance as well. So we'll as always start with the additional information. Additional information before preparing the final set of financial statement for the year ending 31st March 2025, the following information should be taken into consideration. Okay. Composition of operating expense used in the preparation of draft income statement is as follows. Okay. Administrative expense, a balance of 6,500 is given. So in your expense analysis sheet, you can say admin 6,500, the balance that is given. Okay. Distribution cost 6,900. 6,900. All right. Depreciation of manufacturing plant. Now, the depreciation of manufacturing plant should go to the manufacturing account, right? It should go to the manufacturing account, not to the expense analysis sheet. It is not a admin expense or distribution expense. It is a manufacturing, a production overhead. Okay, we'll come to that part. Then next, now see here. Okay, I'll tell you all what to do then. Now, production overheads are recorded in the manufacturing account. Okay, that means, and after that, the total production cost will be taken to cost of sale, right? In a manufacturing business, you will not have purchase. Instead, you will itself produce the goods, and the production cost you will take it to your cost of sale, right? Then, if the depreciation of the manufacturing plant should be included in the production overhead, then it should include in the total production cost. Then it should include in the cost of sale as well. So here we don't have to prepare any manufacturing account. Instead, what we can do, the depreciation of the manufacturing plant, we can directly add it to your cost of sale. Okay, cost of sale. There's another adjustment as well. So for now, I'll show here plus 6,000. Okay, 6,000. Depreciation of office equipment. That is a admin expense. That is a admin expense. Now, if that is wrong, we will have to correct it. But for now, we'll just record it. Depreciation of office equipment. How much was that? Given a 10,000. I think there could be a mistake in this when we are correcting the remaining adjustment. Okay, so we'll keep it aside. And then factory building rent. Factory building rent will be an admin expense. Building rent. Building rent. That was building rent. Okay. A factory building rent. Sorry. Factory building rent also will be added to the manufacturing overhead. All right. Then, okay. All right. So factory building rent also should be added to your cost of sale because it will be added to your production overhead. Then it will be a part of your total production cost. That total production cost is recorded under cost of sale. Therefore, that also should be added to cost of sale. Okay. Then factory building rent. Okay. Income tax paid. Okay. Income tax paid. You will not record it under the operating expense, not under admin or distribution. That we'll calculate later. So the first adjustments are done. Okay, we'll move to the next one. The inventory shown in the trial balance has been ascertained based on the manufacturing cost erroneously calculated in preparing draft income statement due to the non-inclusion, due to not including some of the manufacturing expense. The cost of the finished good inventory is equal to 1/5 of the manufacturing cost. There were no raw material or work in progress as at 31st March 2025. Okay, now we'll do this adjustment. Now the cost of sale given, okay, working number one, cost of sale. Now the drafted cost of sale given in the drafted income statement is 40,000. Is 40,000. Okay. We have not included the depreciation of manufacturing plant and the factory building rent. That should be added to cost of sale. Manufacturing plant depreciation, 6,000, and factory rent 2,000 we have not added. Okay, next, now they are saying the cost of the finished good inventory is equal to 1/5 of the manufacturing cost. Of the total goods that we produce, 1/5 of that are remaining as closing stock, it seems. Okay, out of that, 1/5 are remaining as closing stock. Then out of this manufacturing plant depreciation and factory rent of 2,000, from these also 1/5 should be removed and put to your closing stock, right? Therefore, you can deduct closing stock. Okay, now already they have calculated the closing stock as 10,000. Okay, then that they have deducted in cost of sale. Now you don't have to deduct that again. What you have to deduct, 1/5 of this excluded cost. So here totally it is 8,000. So 1/5 of that will be so here manufacturing plant depreciation 6,000, factory rent 2,000, totally 8,000. 1/5 of that is 1,600. So you should remove 1,600 and add it to your closing stock of 10,000. Then your corrected cost of sale will be 40,000 here. 40,000 plus 6,000 plus 2,000 minus 1,600. That will be 46,400. 46,400. Cost of sale 46,400. Okay. Then this 1,600 you have to add to your closing stock. Now the closing stock given in the trial balance is 10,000. For that you have to add the 1,600. Then the closing inventory will be 11,600. So here you can say for cost of sale working number 1. Okay, then that is done. Moving on to the next one. Director's fee of 7,500 and audit fee of 2,100,000. So 7,500,000 and 2,100,000 has neither been paid or accounted. They have not paid nor accounted. Then you can record that in your expense analysis sheet. Audit fee and director fee. Director fee was 7,500, so 7,500,000, and audit fee was 2,100,000. Now, since it has not been paid, you will have to record it as a current liability as well. Okay, audit fee payable 2,100, director fee payable, director fee payable 7,500. Now, in your exam paper, there might not be enough of space to write all your current liabilities. So, these accrued expenses you can separately show as a working as other current liability and show it separately, and only the main current liabilities you show it separately here, like income tax payable, trade payable, VAT control balance, and then what is the lease liability, current liability portion, those you can show separately. These are other accrued expense you can show as a working in other payables. Okay. Then moving on to the next adjustment. Information relating to property, plant, and equipment are as follows. Okay. All the items of PPE are depreciated on straight line method and they were available for use from the date of purchase. The manufacturing plant was revalued at its market value of 80 million on 31st March 2025 on the closing date. However, the revaluation surplus shown in the trial balance has been calculated only by considering the difference between revalued amount and the cost of the plant. Okay, now you have to find the revaluation surplus from the carrying value of the plant, no, not from the cost. This plant was acquired on 1st of April 2024. On this date, the useful life and residual value of the manufacturing plant was estimated as 10 years and rupees 7,500, 7,500,000 respectively. Okay. So now, on 1st of April 2024, well, information relating to office, no, manufacturing plant. Manufacturing plant was revalued at a market price of 8 million. 80 million. Okay. 80 million. So that you can record as the closing balance. Manufacturing plant, closing balance 80 million. Since in the closing date, they revalued it for 80 million. Okay. Now the depreciation for the year will be, the depreciation of the manufacturing plant for the year is 6,000. Okay, there won't be any opening balance because it's a newly started business. Now, when you're revaluing an asset, okay, you will have to remove the depreciation, right? 6,000. You have to remove the depreciation. Okay, then here you can show removal of depreciation 6,000. Okay, then how much will be the revaluation surplus? Okay. The revaluation surplus they have calculated is wait. The manufacturing plant was revalued for 80 million. The revaluation surplus in the trial balance has been calculated only by considering the difference between revalued amount and the cost. Okay. So how much is the revaluation surplus? So revaluation surplus is given in the trial balance as 12,500. So what are they saying? They have calculated the surplus by looking at the difference between the cost and the revalued amount. So if the revalued amount is 80 million, 80,000, okay, if you're writing in thousands, and the revaluation surplus they have calculated when comparing the cost is 12,500, then if you deduct 12,500 from 80 million, you will get your cost as 67,500,000. right? Then that will be your opening balance. Now remember, this is a newly started business and they purchased this manufacturing plant during the year. Okay, it was purchased during the year. Then you're going to record that 67,500,000 under additions. Okay, under additions, not opening balance. There won't be any opening balance. Then you can reverse and find out what is the correct value of the revaluation surplus. That will be 80,000 plus 6,000 minus 67,500. Revaluation surplus will be 18,500,000. That will be the correct surplus. The carrying, there won't be any closing accumulated depreciation. Closing carrying value will be 80,000. Okay. So now what you can do, this revaluation surplus of 18,500,000, you can record it under other comprehensive income. It's a new first time revaluation, right? Manufacturing plant surplus 18,500. Okay, that is done. Then next, information relating to office equipment is as follows. On 1st of April 2024, we have purchased office equipment worth 30,000, which has a useful life of 5 years. On 1st of October 2024, office equipment worth 20,000 was purchased. That also has a useful life of 5 years. Totally, the purchase of office equipment during the year is 50,000. So you can go and put on the additions 50,000. Okay, office equipment. Office equipment. So in 2025, actually the company accounts is not a very complicated question. Okay. But then it was tested a bit differently by adding manufacturing account related cost, which was already tested in 2023. And this drafted income statement thing doesn't make a huge difference compared to the previous year company account question. So then the estimated residual value of the office equipment is zero. The office equipment has been depreciated for the entire year without considering the acquisition date. Now, for the initial one, you can calculate for full year because it was purchased on 1st of April 2024. Year is ending on 31st March 2025. But the second one, it was purchased in the middle of the year on 1st of October. So 1st of October 24 to 31st March 25 is only 6 months. So that also they have calculated for a full year. Now we'll see what will be the depreciation. Now for this first one, it will be 30,000 divided by useful life 5. There is no residual value. Depreciation for a year will be 6,000. Okay. For this office equipment purchased on 1st of October, cost is 20,000. Divide by useful life 5 years. For 1 year, the depreciation will be 4,000. 20,000 divided by 5, 4,000. But then, because, okay, because it is purchased on 1st of October, we have to calculate depreciation for 6 months. That is half a year. So the 1 year depreciation for 4,000, divide that by 2 for half a year, depreciation is 2,000. Then the correct office equipment depreciation will be 8,000. Okay, the office equipment depreciation will be 8,000. So you can record here depreciation for the year 8,000. Okay, and in the expense analysis sheet, you can say depreciation of office equipment and admin expense 8,000. So the 10,000 they have calculated earlier is wrong. You can cut it off. We record the correct one. Then now you can balance your PPE table. 50,000 minus 8,000. 50 minus 8, that is 42,000. Total carrying value of PPE will be 82 plus 42,000, 122,000. So you can record in your SOFP PPE, you can say note number 2, 122,000. Okay. Then moving on the next one. The company entered into a lease agreement on 1st of April 2024 to obtain the right of use of a motor vehicle, and on this date an initial payment of 20 million was made. Okay, they made an initial down payment of 20 million. The present value of the total lease installment as at 1st of April 2024 was 30 million. Okay. Uh, According to the lease agreement, 5 equal installments. Okay, first of all, down payment, we'll add it under note number 3. Note number 3, right of use asset, we'll write in rupees 1000. First of all, the down payment is given. Down payment, down payment was 20 million. Down payment 20 million. So I'll write as 20,000. And then present value of lease liability you have to add. That was 30 million. Okay, the lease liability amount 30 million. You have paid 20 million in your own money, and 30 million is purchased on lease. Then the total cost of the right of use asset is 50 million. Okay, remember that. Then next, what is happening? According to the lease agreement, 5 equal annual installments of 8 million each are payable during the lease term, and the first installment was paid on 31st of March 2025. Okay, they have paid the installment, the first installment during the end of this current year. The ownership of the motor vehicle is not transferred to the lessee at the end of the lease term. Estimated useful life of the motor vehicle is 8 years and the residual value is 0. Now, since the ownership is not transferred to us, we have to calculate depreciation at the lower of useful life and lease period. So here the lease period is low, that is 5 years. So since the ownership is not transferred to us, we have to depreciate it based on the lease period. Okay, but if the ownership is transferred to us only, we have to calculate depreciation based on useful life. Okay, then here we have to calculate depreciation because on the lease period, because lease period is lower and the ownership is not transferred to us. Okay, and also the interest is given. The interest for 2025 and 2026 are given here. Uh, the initial payment and first lease installment paid has been debited to the right of use account. So here right of use asset, they have added only the initial payment of 20,000 and the lease installment of 8,000. That is not how we calculate. We have properly calculated the cost as 50,000. Now we can prepare our lease liability account. We'll prepare a lease liability account. Lease liability. So right of use under lease liability, we have taken 30,000. We have paid the installment in cash 8,000. This installment includes interest expense. The interest expense included in the installment for this year is 3,126,3126 interest. So interest, you will debit it to finance expense, credit to lease liability. So here you can say lease interest under finance expense 3,126. Okay, and then here you can get the BCD, closing liability. You can balance this off 30,000 plus 3,126, that is 33,126,000. 33,126,000. If you deduct 8,000, you will get the closing balance as 25,126. Now, this 25,126, you have to divide as current liability and non-current liability. Okay, current liability, how do you find? Next year's installment minus next year's interest. Next year's installment, every year the installment will be 8,000, right? Installment amount is always 8,000. Next year's interest is given here 2,618. 2118. 2618. Okay. So 2618, then the current liability will be 8,000 minus 2618, 5,382. 5,382. How do you find non-current liability? Non-current liability equal total liability 25126 minus current liability 5382. That will be 25126 minus 5382, 19,744. 19,744. Now you can put a working number for this if you want. Later we'll put it. So here you can say under non-current liability, lease liability 19,000, 19,744. 19,744. Under current liability, you can say lease liability, that is 5382. 5382. Okay. Then next, the income tax pay. Wait. We are not done yet. We have to calculate the depreciation minus accumulated depreciation. There is no any opening accumulated depreciation because this is newly acquired during the year. So only the depreciation for this year will be there. So here, since the ownership of the asset is not transferred to us, we have to depreciate based on lower of useful life and lease period. The useful life is 8 years, lease period is 5 years. So the lower is the lease period. Then 50,000 cost divided by 5, depreciation will be 10,000. Then finally, the carrying value will be 40,000. The carrying value of 40,000 you can record here in non-current assets. Say note number 3, 40,000. And the depreciation you will have to record it under where you have to see here to obtain the right of use asset of the motor vehicle. This motor vehicle is used for distribution of goods. Then the depreciation of right of use asset 10,000 should be recorded under distribution expense, and that is also done. The income tax payable as at 31st March 2025 is estimated as 550,000. Okay. Now we'll draw a small income tax account. Can draw it here. Income. Okay. There won't be any opening income tax because this is a newly started business. Income tax paid amount is 1,100. So that will be here cash credit income tax debit 1,100. Income tax payable for the closing date. Income tax payable as at 31st March 2025 is estimated as 550. The closing liability amount is 550. Then the for the year amount will be 1,100 plus 550, 1,650. It will be 1,650. 1,650. Then that will be your income tax amount. Minus income tax 1,650. Okay. And then the payable amount of 550 you have to record it under current liability. Under current liability you can say income tax payable 550. And as for income tax, you have to show a proper working. The standard working for income taxes, now we'll say, okay, this is working 1, distribution expense working 2, admin expense working 3, other expense working 4, finance expense working 5. So for income tax, we'll say working 5. Sorry, working 6. Working 6, income tax. Okay, then estimated income tax. you have to record first estimated income tax for the year. For that, you have to plus or minus the under or over provision of income tax. Then only finally you will get the income tax expense for the year. Now the income tax expense for the year, the P&L amount is 1,650 that we found. Now since this is a newly started company, the under over provision will come if there is a last year's estimated amount, right? There won't be any under over provision. Therefore, the estimated income tax also 1,650. Okay, that is done. That working is done. So here you can just label and keep. It's gonna be working 2, working 3, working 4, working 5, income tax, working 6. Okay, then that is also done. Then the last adjustment. Financial statement of the company were authorized for issue by the directors on 31st of May, and the following events have been occurred after 31st March. So events after reporting period. LKS 10. LKS 10. Okay. The verdict of a court case filed by a customer against the company was given on 30th of April 2025. The verdict of a court case filed by a company, filed by the customer against the company. Okay. A customer had filed a case against the company. This case was filed on 10th of December. Okay. During our year, a customer had filed a case. Now the confirmation, the verdict, the final judgment given by the court, it was given on 30th of April 2025 after the reporting period. What is the judge saying? Accordingly, rupees 600,000 was paid by the company on this date as a full settlement of the claim. So after the reporting period only we are getting to know how much we are supposed to pay as the compensation. Okay, therefore, since this case was filed during the year, we are recognizing it as an expense, as a liability of the current year. And you can say under other expense, you can say compensation 600,000. And now this was paid after the reporting period. No, reporting period is 31st March 2025. Okay, we paid it on 30th of April. So that's like in the future. So on 31st of March, we will show it as a liability because it was not paid during the year. It was not paid during the year. Okay. So then here you can say provision for compensation. Provision for compensation 600. Okay, that is done. Then a trade debtor existed as at 31st March 2025 was declared bankrupt by the court on 5th of May. Okay, on 5th of May, the court has declared them bankrupt. Okay, it's before the authorization date and the debtor was there during the year. The trade receivable shown in the trial balance included 3,500 receivable from this debtor. After making several reminders, the company was able to collect only 1,200 from this debtor on 1st of May. Then the debtor who went bankrupt, okay, he had a balance of 3,500,000. Out of that 3,500,000, we were somehow able to recover 1,200. We reminded him several times and got 1,200. The remaining 2,300, that means he didn't pay. The difference is 2,300. He didn't pay that. And what you have to do, that 2,300, you have to record it as bad debt. Okay, it's a adjusting event. Bad debt is a distribution expense. Bad debt 2,300, and you have to deduct that amount from your debtor's amount. The debtor value given in the trial balance is 25,800. From that, you have to deduct 2,300. Then you will get 25,800 minus 2,300. You will get 23,500. Okay. Then next one. Directors propose the final dividend of 500,000 for ordinary shareholders on 25th of April, 25th of May 2025. Directors proposing dividend is a non-adjusting event. You have to show that in a note. You can say note number 4. Note number 4. You can say directors propose. You can just copy paste that. Directors propose a final dividend of rupees. Is it 500,000? Of rupees, yeah, of rupees 500,000 to ordinary shareholders. No, for the ordinary share. For ordinary share, yeah, okay. So to the ordinary shareholders, on 25th of May 2025. Okay, you can show that. So then we didn't do note number 1. So in note number 1, profit before tax, you have to disclose some of the expenses. It could be any expense. Here you have depreciation of office equipment, audit fee, any of this you can record. So we'll record audit fee. Audit fee you can write it in thousands if you want. Audit fee 2,100. Director fee 7,500,000. Lease interest 10,000, 10 million. Bad debt, I'll record bad debt. You can record anything, don't worry. Compensation can be recorded. Depreciation of right of use. Sorry, give me a minute. The lease interest is lease interest is 3,126,000. Bad debt 2,300,000. So remember, you can record any 4 expenses. So for disclosing any 4 expense, you will get 2 marks there. Okay, so then that's done, and you can label here saying note number 1. Okay, so I'm following the recent updated marking schemes. In the updated marking schemes, there are only 4 notes. Okay, from 2024 onwards. Here profit before tax. Okay, not profit for the year. Profit before tax is only the note. We are showing the note for profit before tax. So profit before tax will be note number 1. PPE will be note number 2. Right of use asset note number 3. And any other disclosures will be note number 4. Okay, to show like whatever the non-adjusting events after the reporting period, directors propose final dividends, all of those are disclosed under note number 4. Whatever the other things you can show as a working. Cost of sales, other income, expenses, income tax, okay, all of those can be shown as workings. Here, inventory, trade receivable, cash and cash equivalent, any of it can be shown as workings, no issue. Okay, then all of that is done. We have adjusted all the adjustments. Now you can record whatever the figures we didn't record. So sales revenue 92,000, 92,000, and these are adjusted in the PPE note. Right of use asset adjusted, inventory adjusted. Cash is 2,500, 2,500. Trade receivable done. Trade payable 20,000. Trade payable 20,000. Okay. So here in your most of the time, because of the margins in your answer script, you won't have this much of space to write your current liability. So this audit fee, director fee payable, and yeah, these two you can show it as a working. Okay, no issues. Then if there's space, if there's around 6 lines, no problem. You can show all this in the same page as well. No need to show a working. But I feel like so when I was doing the paper also, it took me like I think I did it in a working because there were no enough space to write all the current liabilities in the answer script itself. Okay, so little look into that as well. All right. Then next, stated capital ordinary shares 125,000. Now, this is a newly started business. And how will you get this stated capital? By issuing shares, right? So don't record it as the opening balance because it's a newly started business. There won't be opening balance. Okay. So you can instead say, if you want, you can put opening balance and put blank. You can say share issue 125 million. Okay, that is done. Um, Profit after tax. Now we have adjusted our profit. Revaluation surplus recorded. Interim dividend paid 1,200. Now dividend you will pay through your profits. So firstly record your total comprehensive income and then minus interim dividend. Interim dividend you will record it. The dividend actually paid amount. Interim dividend 1,200 you will deduct from retained earnings minus 1,200. Okay. Now everything is recorded. Now the first thing you have to do is to balance off your expenses. 6,900 plus 10,000 plus 2,300, that is 19,200. Admin expense 6,500 plus 8,000 plus 2,100 plus 7,500, that is 24,100. Then other expense will be only bad debt 600, finance 3,126. Okay, 23,500. Yeah, 19,200, 24,100, 600, 3,126. So you can record it here. Distribution expense was 19,200. Admin expense 24,100. Other expense 600. Finance 3,126. Then total expenses. Now, okay. Gross profit will be okay, don't forget this. Now here other income was given as 4,500. No mistakes there. You have to record that. I have missed that. Time I remembered 4,500. Okay, so make sure every time when you record something to put a tick. Okay, make sure somehow put a tick nicely so you see that you have missed anything or recorded everything properly. Okay, 4,500. Then okay, gross profit will be 92,000 minus 46,400. That will give you 45,600. Okay, 45,600. Let me show it clearly. Oh no. Give me a minute, I'll put that line. Okay, I mean, yeah, sorry, it's not a straight line, but yeah, that doesn't matter. Then, yeah, so the total expenses will be 19,200 plus 24,100 plus 600 plus 3,126. That will be 47,26. 47,26. Then your profit before tax will be, okay, your gross profit is 92,000 minus 46,400. That will be 45,600. 45,600 plus other income 4,500 minus total expense 47,026. That will give you 3,074. 3,074. Profit before tax 3,074 minus income tax 1,650. Profit for the year will be 1,424. Profit for the year 1,424 plus manufacturing plant revaluation surplus 18,500. You will get your total comprehensive income as 19,924. So then you can record your profit for the year 1424 under retained earnings for total comprehensive income, and the manufacturing surplus 18,500 you can record under revaluation surplus. Then finally your closing balance, here you can record your total comprehensive income 19,924. Okay, total will be 125,000, 18,500, no general reserve, and the retained earnings 1424 minus 1,200, 224. Your total equity will be 125,000 plus 18,500 plus 224, that is 143724. Okay, next. Yeah, then you can record your stated capital as 125,000, revaluation reserve 18,500, general reserve 0, retained earnings 224. Then your total equity 125,000 plus 18,500 plus 224, that is 143,724. Then now you can balance it off. Your total current assets will be 11,600 plus 23,500 plus 2,500. That is 37,600. Then your total asset will be 37,600 plus the non-current assets 122,000 plus 40,000. 199,600. 199,600. So your equity is given, non-current liability given. Current liability 2,100 plus 7,500 plus 5,382 plus 550 plus 600 plus 20,000. That will give you 36,132. For this, if you add the non-current liability and equity, 19,744 plus 143724, you get your total equity and liability. Total equity and liability as 199,600. So to be honest, 2025 company accounts wasn't actually complicated. It was presented differently, but the adjustments are very simple and won't consume you a lot of time compared to some of the previous years. Okay, so then yeah, that's all for the company accounts question of 2025. So this is your income statement, SOFP, statement of changes in equity. Then you have notes and workings here, notes and workings. Okay, done. Moving on to the second question. So in 2025 level, A part, a payroll was tested. So under labor costing, they have given a few details and said to prepare the payroll of Nadun Garments. Then there are 4 employees, employee number 1 to 4, Silva, Fernando Kumar and Nadisha. So then Nadun Garment Private Limited uses both time basis and output basis in paying salary. Time basis means for the number of hours, output basis based on the amount of units produced. Okay, contributions made to the employees provident fund for the month of September are as follows. Okay, now they have given the employer EPF and employee EPF in this particular details. Okay. Now we need to prepare our table, right? Now look into what are our earnings and deductions so you can know how many columns. The manager is paid a monthly basic salary. You will need a basic salary column. Okay. Every employee will be given a basic salary. The manager is paid a monthly basic salary of 108,000 and the basic salary for other employees are calculated based on the number of units they produce. Okay. EPF and ETF contribution are calculated from the gross salary. Okay. Including all the allowances. Okay. The employer contribution to ETF is 3%. Then you will need a ETF column. Monthly cost of living allowance. So under earnings, you will need a cost of living allowance column. Manager is paid a fixed monthly traveling allowance in addition to the cost of living allowance. Then you will need another traveling allowance column, or you can name it fixed allowance or special allowance column. Then those are the earnings. Machine operators are paid based on the output basis indicated below. So you have Fernando and Kumara. They produce in number of units into a particular rate. The quality controller Nadisha has is paid 100 per unit to certification of quantity of to certify a quantity of 590 units. Then that is done. All the earnings. Uh, Fernando and Nadisha have obtained staff loans and their monthly loan installment deductions are 12,500 and 5,000 respectively. So then for deductions, you need a loan deduction and employee contribution to EPF is a deduction. Okay, now this is your table. You will need the name. You can put another small column if you want as employee number, earnings, gross salary, you will put the deductions, then you get the net salary, and separately you should show the EPF and ETF employer contribution. So then you have Silva, Fernando, Kumara, and Nadisha. Silva, Fernando, Kumara, Nadisha. Okay. Now, here they have directly given the EPF contribution of employee and employee. No, you can record that. We'll record it in rupees, no need thousands. The values are small. Ne? We'll record it in rupees. 16,200 employer contribution, 16,200, 14,160, 9,600, 9,120. Employee contribution will come under deductions 10,800, 9,440, 9,440, then 6,400 and 6,080. 6,080, this is 8, 6,080. Then next. Now they are saying that EPF and ETF are calculated based on gross salary. Now we can indirectly find our gross salary. I'll tell you all a method. Now you all know from the gross salary, if you deduct the EPF contribution of the employee, only you get your what? Net salary. Now from gross salary, when you make your deductions, EPF employee, loan deductions, okay, that's how you get your net salary. Now you know your gross salary is 100% because EPF is calculated based on gross salary. No? In this question, they are clearly saying EPF and ETF are calculated on gross salary. Then, if the gross salary is 100%, now the EPF employee is calculated on that 8% of the gross salary, 8% of 100%. Now, EPF employee, for example, let's say Silva, he has 10,800. How much will be his gross salary? 10,800 divided by 8 and multiply by 100, you will get his gross salary as 135,000. Same for all the employees. 9,440 divided by 8 into 100, that's going to be 118,000. Kumara, 6,400 divided by 8 into 100, 80,000. Nadisha, 6,080 divided by 8 into 100, 76,000. These are your gross salaries. Easy to find. Okay, now I'll erase this thing. Next. Now, Silva's basic salary. The manager, Silva, the manager is paid a monthly basic salary of 108,000. 108,000. Okay. The basic salary of other employees are paid based on output basis. Okay. EPF and ETF contribution are calculated based on gross salary. Okay, we can calculate ETF also. 3% of 135,000 is into 3 divided by 100, that is 4,050. 3% of 118 is 3,540. 3% of 80,000 is 2,400. And 3% of 76,000 is 2,280. That is done. Then next, monthly cost of living allowance of 17,000 is paid to every employee. So 17,000 for everyone. 17,000, 17,000, 17,000, 17,000. Okay. The machine operators are paid the basic salary on the output basis as indicated below. In addition, no, I didn't see this. The manager is paid a fixed monthly traveling allowance in addition to the cost of living allowance. How do we find that? They have not given the value. Now you know the gross salary. From the gross salary, if you deduct the basic salary and cost of living allowance, you can find the special allowance. 135,000 minus 17,000 cost of living allowance minus basic salary 108,000. Special allowance is 10,000. The traveling allowance is 10,000 for him. Okay, 10,000. Then the machine operators are paid the basic salary on the output basis as indicated below. In addition, the machine operators are paid a production allowance based on their performance. Now, for the manager, he's getting a traveling allowance separately. The production employees are getting a production allowance. If you want, you can show it separately. You can put traveling allowance column and production allowance column, but if it's not enough space, you can combine and say special allowance for both of them. Okay, then you can separately also show. So here, first of all, we'll find the basic salary. Basic salary is paid based on the output. 350 into 250, 350 units into 250 per unit, 87,500. And for Kumara 240 into 250, 60,000. Then you can find their allowance. Their allowance will be 118,000 minus 87,500 minus cost of living allowance 17,000. Special allowance will be 13,500. Kumara 80,000 minus 17,000 minus 60,000. His allowance will be only 3,000. Okay. Then here the quality controller is so Nadesha is the quality controller. The quality controller has been paid at a rate of 100 per unit for the certification of quality of all 590 units. So 590 into 100 will be 59,000. So 59,000 plus 17,000 or 76,000. So there is no any special allowance for Nadesha. Fernando and Nadesha have obtained staff loan and their monthly loan installment deductions are 12,500. Sorry, Fernando and Nadesha, right? 12,500 and 5,000 respectively. Okay. Then now you can total everything. Total deductions will be 10,800, 12,500 plus 9,440, 21,940. Here 86,400 and sorry 6,400. Let me erase that. Okay. Here it was 21,940. Here 6,400 And the last one is gonna be 11,080. 11,080. Okay. Then now we'll find the totals. No, we'll find the net salary also. Gross salary minus total deductions, net salary. Silva 135,000 minus 10,800. You get 124,200. Then Fernando, gross salary 118,000 minus deductions 21,940. That will be 96,060. Kumara 80,000 minus 6,400, 73,600. And Nadisha 76,000 minus 11,080, 64, 920. 124, 200, 96,060, 7,364, 920. Okay. Now you can find the totals of all the columns. That will be 314,500 and 68,000 and 26,500, 409,000, loan deduction 17,500, EPF employee contribution total 32,720, total deductions are 50,220, net salary 358,780, EPF employer 49,080, and ETF expense 12,270. So these are the totals of the payroll sheet. So you can say here payroll of Nadun Garment for month end. You can write it in two separate lines. Month end. You can say, or you can say for the month of September 2025. So this is your payroll, 10 marks. Not a difficult question. Okay, it's a lot of values to write. You need to do it on time. Okay, you should take around 10 to 15 minutes. So to do this question. All right. Then maybe ideal is 10. Yeah, 10 minutes is the ideal for you to do this question. Okay, then that is done. Then right. Then moving on to the overhead analysis sheet question. John PLC manufactures two types of mattresses, A and B. The company consists of two production departments, namely machine and finishing, and a service department named as stores. Okay. All these departments are located in a single building. The expected activity level of the company is 5,000 mattresses, comprising of 3,000 type A mattress and 2,000 from type B mattress. Okay. The overhead absorption rate of machine department and finishing department are calculated based on the machine hours and direct labor hours respectively. Okay. Yeah, so for machine department, OAR is calculated based on machine hours. Finishing department, OAR is calculated based on labor hours. The overhead absorption rate have been already calculated by the company are given below. So they have already calculated the overhead. Okay. But it seems like they have missed to record certain things or they have done some errors. Now to correct that only we are going to do. Now first of all, you're supposed to record your drafted overhead. Drafted overhead means the wrong overhead. You have to record that first. Now they have already calculated the OAR of 300 per machine hour for machine department, 200 per direct labor for finishing department. Now this is the OAR. Now how to find the total overhead of machine department? Now machine department OAR is calculated based on machine hours. And how to find the total overhead? OAR 300 per machine hour 300 into total machine hours 30,000, overhead will be 9 million. 300 into 30,000, 9 million. Okay, so 300 into 30. So you can write it in thousands, 9 million. Machine department, 9 million. So 9,000. And then for the finishing department, 200 per direct labor into totally 20,000 labor hours. Total overheads will be 4 million for the finishing department. The total of that is 13 million. Okay, that is done. Then next. However, in the subsequent investigation of the overhead analysis sheet, the management of the company has found the following errors and omissions. Further, the management has proposed revisions for some overhead absorption basis. They have made some errors, they have omitted certain overheads, and also the management has proposed to change the basis of apportioning their overhead for certain transactions. Okay, first one. The budgeted indirect wages of 1 million and 2 million relates to machine and finishing department respectively. However, these amounts has been allocated erroneously as 2 million to machine department and 1 million to finishing department. Okay, so they have to record 1 million for machine department and 2 million for finishing department. They have done the opposite. So simply what you have to do, remove 2 million from machine department and add it to finishing department. Okay. All right. Before that, um, yeah. So first of all, we'll record our overhead, reapportion the stores amount, Okay. Yeah. So we have to reapportion later. Now, so firstly, we'll remove the stores overhead from this amount. We'll remove the stores overhead and put it away. The budgeted total overhead of the stores department that has been considered in the preparation of overhead analysis sheet is 2 million. Okay, they have already calculated the overhead of the store as 2 million, and they have apportioned it. See, it is also proposed to change the reapportion basis of the total overhead to the stores department to the production department as follows. The basis used. Earlier, they apportioned it based on number of stores requisitions issued. Okay, and they have proposed to change the method to raw material consumption ratio. Now, this 2 million might have been reapportioned based on the old basis number of store requisition issued. So you have to remove that. Sorry, I'm going off. You should remove that from the machine and finishing department and record it under store 2 million. Earlier, how did they reapportion based on number of store requisition note? That ratio is store requisition note 150 is to 100. That is gonna be 3 is to 1. No, wait. 3 is to 2. Okay, 3 is to 2. Here you can say stores based on stores requisition note 3 is to 2. 3 is to 2 will be 2000 divided by 5 into 3200 and 800. So what did we simply do? We simply, okay, undid the reapportionment which we did earlier. We removed it. Okay, you can get the total overheads that are previously calculated for all the three departments. That is, so you are removing this 9,000 plus 1,200, that is 7,800. 4,000 minus 800, that is 3,200, and stores department 2,000. Now here, don't worry, even if you had recorded this reapportion part at the end, nothing's gonna happen because it's management accounting and there is no fixed structure for this, right? And as long as you get the final answer as the same thing in the marking scheme, you will get the marks. Don't worry about that. Okay, then we have calculated the total of all three departments before all this consideration of errors and omissions. So you can now record this. The budgeted indirect wage of 1,000 and 2,000 for machine and finishing department, they have recorded as 2,000 and 1,000. So remove 1,000 from the machine department and add it to the finishing department. So you can say indirect wage, okay, indirect wage. You are removing 1,000 from machine department and putting it to finishing department. Okay, here total is how much? 7,800 plus 3,200, still 13,000, 13,000. Okay, that is done. Then next. Now here other thing, even if you remove this 2,000 and 2,000, sorry, even if you remove this 2,000 and 1,000 fully and again record 1,000 and 2,000, that is also correct. Okay, then the insurance premium for machine 3,140,000 and 1,860,000 for machine and finishing department respectively have not been considered, so totally omitted. So you can record that. Machine insurance, it is directly given, so you can say direct or you can use the word allocation. Okay, how much is that? 3,140,000 and 1,860,000. 3,140,000 and 8,160,000. So that's top, sorry, 1,860,000. 1,860,000. So 1,860,000 plus 3,140,000, that is 5 million. 5 million. Then next, the following revisions have been proposed to the overhead absorption basis in order to provide a more reliable, a more suitable presentation of overhead for the respective department. Depreciation of machine. Earlier they have calculated on cost. Now they are planning to calculate depreciation based on the carrying value. So technically earlier they are calculating depreciation based on straight line method. Now they on carrying value means they are going to change the method to reducing balance method. Okay, now they have already divided the depreciation based on the cost. Okay, now they want to change it to the carrying amount method. The factory electricity, already they have divided based on flow area. Now they want to divide it based on electricity consumption. Now we'll do that. Now here, depreciation. How much is the depreciation? The budgeted annual depreciation of machinery and budgeted factory electricity are 2,250,000 and 600 respectively. First of all, we'll remove it based on the old method. Depreciation, old method is the cost. Based on the cost of that machine, that is 8 is to 6 is to 4. When you simplify it, it's gonna be 4 is to 3 is to 2. 4 is to 3 is to 2. We are gonna remove it based on this method. Depreciation 2,250,000 minus 2,250. If you are dividing it, 2,250 divided by total ratio is 4, 5, 6, 7, 8, 9. 1,000. You are removing 1,000 from machine department. Removing 750 from finishing department. And removing 500 from source. And now you are recording the depreciation based on the proposed new method, that is based on the carrying value. Carrying value, the ratio is going to be 6 is to 2 is to 1. 6 is to 2 is to 1. Okay, 6 is to 2 is to 1. 2,250. Again, you have to record based on the proposed method. 2,250 divided by total ratio, still 9 into 6, 1,500. 500, 250. Okay, that is done. Then electricity, earlier they divided based on flow area. Flow area. Okay, the method that is used is flow area. The proposed method is electricity consumption, kilowatt hours. Flow area ratio will be 3 is to 2 is to 1. How much is the electricity bill? Electricity amount is 600,000. Depreciation 250. Budgeted factory electricity 600,000. So 600,000 you have to divide based on 3 is to 2 is to 1. You have to remove it based on the old method. That's gonna be 300, 200 and 100. Okay. Now you can record the electricity based on the proposed method that is based on the kilowatt hours. So based on the kilowatt hours, you have 5, so 10 is to 1 is to 1. 10 is to 1 is to 1. So 600, you are going to record again. 600 divided by total ratio 12 into 10, 500, and here 50 and 50. 50, 50. Okay. Then that is done. So everything is done. Next, what we have to do is we have to total and again reapportion. We have to again reapportion our total overhead based on the raw material consumption ratio. Okay. I will get our total. That's going to be okay. So from here, from this total, you continue 13,000 plus 5,000. So here, technically, these are not changing. Plus and minus, then it's gonna be finally 18,000. Then here 7,000, here 7,800, 7,800 minus 1,000 plus 3,140 minus 1,000 plus 1,500 minus 300 plus 500. That's gonna be 10,640. 10,640. Finishing department 3,200 plus 1,000 plus 1,860 minus 750 plus 500 minus 200 plus 50, 5,660. And then the stores department 2,000 minus 500 plus 250 minus 100 plus 50. That's gonna be 1,700. 1,700. Okay. Sorry, you're not supposed to record the line. Fine. Then what you have to do next is, so you don't record this line here. What you have to do is now you have to reapportion it again. Reapportionment based on the raw material consumption ratio 8 is to 2. So 4 is to 1. 4 is to 1. Here consumption ratio 80% and 20%. So that is 4 is to 1. Okay. Then if you divide this 1,700 you remove from here, divide it based on 8 is to 1. Sorry, 4 is to 1. That's gonna be 1,360 and 340. Then you can get your final total. Final total. Okay, still 18,000 here. 10,640 plus 1,360, that is 12,000. And here it is going to be 6,000. And stores is going to be 0. So we are done with our overhead analysis sheet. So yes, acceptable. This is a bit harder compared to the normal previous years. Okay. The correction of overheads are tested earlier, but this is the hardest out of all of it. Because here you had errors, omissions, and also newly they have added proposed changes of the basis as well. Okay, so you need to be careful, but it's a very easy question there. Okay, so that is done. Then moving on to the next part. So here the total overhead already calculated for each department done. Okay, we have done that 13,000, 7,800, 3,200, 2,000. Rectification of errors and omission done. Adjustment of proposed revisions done. and the reapportionment finally done. Then revised overhead absorption rate. Okay, second requirement, revised OAR. So OAR of machine department will be production overhead of machine department divided by machine hours. So machine department, machine hours. Production overhead is production overhead is 12,000, so 12 million divide by machine hours. Machine hours is still the same. They didn't tell anything that wrong. That is okay. 30,000. You can record that 30,000. And the OAR will be 12 million divided by 30,000 hours. That's gonna be rupees 40 per machine rupees 40 per machine hour. Then overhead absorption rate of the finishing department, that will be production overhead, budgeted production, sorry, it should be budgeted overhead, not production overhead. Yeah, it is production overhead, but budgeted production overhead, budgeted overhead divided by labor hours. The overheads are 6 million divided by labor hours. 6 million divided by labor hours of 20 million. That's gonna be rupees 300 per labor hour. Okay. And the third requirement, now this is the first one. Third one, production overheads per type A mattress. Okay, production overhead per type A mattress. Then here, the processing time of type A mattress in machine department is 2 machine hours and finishing department is 2 direct labor hours. So overhead, you will have machine hours, you're spending 2 hours, it seems. Per hour, you're spending 40 rupees. Then the overhead is rupees 80. Then finishing department, sorry, here 400, no? 400. So here 800. Finishing department, here machine department, finishing department, you're spending 2 hours again, 2 direct labor hours. Per direct labor hour, 300. Then here 600. 600. Then, yeah, then you can get production overhead per unit of mattress A is rupees 800 plus 600, that is 1,400. 1,400. Okay, 1,400. Production overhead per type A machine. Done. Then next one is cost of production per type of mattress A. Then cost of production. Direct material for, okay, direct cost to produce 1 unit of type A mattress, 4 kilogram into 450, 2 direct labor into 400. Okay, so then fourth one, direct labor, sorry, direct material first. Direct material 4 kilograms into 450. That's gonna be 1,800. 4 into 450, 1,800. Then direct labor, 2 hours into 400 per 800. Prime cost will be 1,800 plus 800 is 2,600, right? 2,600. So production overhead we calculated in requirement 1, right? You can record it here, separately show again, no problem. Production overhead, you can separately show it better, 1400. Then you can get the production cost of 1 unit of material A, that is 2600 plus 1400, that is rupees 4000. Fourth one done. Then the fifth one, profit at the activity level of 3000 units for type A mattress. Okay. The budgeted non-production overhead for the period are 1500 and it is shared equally among the two type of mattress. Okay. So now here the selling price is determined by adding 40% on the cost of production. Okay. So now sales will be sales minus cost of sale will give you gross profit. From that, if you deduct your non-production overhead, you will get your net profit. Sales will, okay, first of all, cost of sale. Cost of sale will be, now to produce 1 unit, 4000 rupees net. 4000 multiplied by 3000 mattresses, that will be 12 million. 12 million. The profit, the gross profit, right? The gross profit is, the selling price is determined by adding a profit of 40% on cost of production. That means the gross profit. So 40% of 12,000 will be 4,800,000. Then the sales will be 16,800,000, right? So the gross profit, if you add your cost of sale, you will get your sales value. Then they are saying the non-production overhead are divided based on both of the mattresses equally. And 1500 divided by 2, that will be 750,000. Then your profit from mattress A will be 4800 minus 750, that is 4,050,000. That is done. So the second question is also done. So then moving on to the third question. Sunrise Traders Private Limited, a wholesale trading company, was established in the year 2023. This company is registered for VAT. The summarized SOSP of the company as at 1st of April 2025 as follows. They have given the opening balances. And then they have given a few transactions and we have to record in the accounting equation. So first of all, let's record the opening balances. Opening PPE carrying value 600, inventory 220, trade and other receivables 60, cash and cash equivalent 130. Then ordinary share capital 600. Okay, they have given the accounting equation in a company accounts perspective. Retained earnings 200, bank loan 100, trade payable 70, and VAT payable 40. First one, purchase goods for 59 million on credit, including 9 million VAT. So on credit, trade payable plus 59 million. So here you have to write it in millions, not thousands. Rupees million. Okay, rupees millions. Out of the 9,000 is purchase VAT. Purchase VAT is an asset. Now here you have a VAT control column, right? So the purchase VAT amount, you can deduct it under VAT control minus 9. It will reduce your VAT liability. Okay, then the actual purchase value will be 50. Inventory will be plus 50. Number one. Second one, sold goods on credit for 118 million, including 18 million VAT. Cost of the good is 70. So you're selling for 118 on credit plus 118 trade and other receivable. Out of that 18 million is VAT. VAT control plus 18, it's a liability. And then out of that, the cost of the good is 70, inventory minus 70. Now here we totally sold it for 118, including VAT. Then the selling price is 100,000. Cost of the inventory 70, then the profit is 30. The profit will go to retained earnings plus 30. Third one, return goods sold previously for 29.5 million, including 4.5 million VAT. Cost of this good was 16 million. Earlier we sold for 29.5 million. They are returning. Then trade receivable minus 29.5. Out of that, VAT is 4.5. You will minus 4.5. Sales return VAT you will deduct. Okay, earlier you added. Now when returning, you're deducting. The cost of the good is 16,000. You're getting the goods back. Therefore, inventory will be plus 16. The selling price of that will be 29.5 minus the VAT included in that 4.5, that will be 25,000. Selling price was 25,000. The cost of it was 16,000. Then the profit of that is 9,000. Then when returning the goods, the profit will return. Then return earnings will be minus 9,000. Then the fourth one, trade creditor of 60 million was settled after receiving a discount of 10 million. Trade credit of 60 million was settled. Fourth one, trade payable minus 60 million. You settled it after getting a discount of 10,000. Discount is 10, retained earnings plus 10. Then how much you will have to pay in cash? Only 50 million. Cash and cash equivalent will be minus 50 million. Then the fifth one, received rupees 75 million from a debtor after allowing a discount of 5 million. Here, you're receiving 75 million from debtor. Cash plus 75 after giving a discount of 5 million. Then how much is the amount totally settled? 80 million. Trade receivable minus 80. Out of that 75 you got in cash and 5,000 you allowed as discount. Then the sixth one, paid a bank loan installment of 50 million, including an interest expense of 10 million. So minus 50 cash. Out of that 10 million is interest, retained earnings, expense minus 10. And then the loan amount included in that will be 40. Bank loan minus 40. Then the seventh one, purchased a new machine for 12 million for cash and also paid raw material cost of 1 million for the initial test run of this machine. Okay, so then purchased a new machine of 12 million for cash. Okay, and also raw material cost of 1 million for initial test run. Now here that is this is a sample testing. Sample testing cost will not be included to the price of the machine. So PPE will be seventh one, PPE plus 12 million. Okay, and raw material cost 1 million will be an expense. The initial testing will be an expense there, minus 1 under retained earnings. Both are done on cash. Totally cash and cash equivalent will be minus 13. Eighth one, paid electricity expense of 3 million relevant to this quarter. Then electricity, cash minus 3, retained earnings minus 3. Donated goods costing 2 million to a school as a business promotion activity. Ninth one, inventory minus 2, retained earnings minus 2. Issued ordinary share by capitalizing 25 million from retained earnings. They are capitalizing retained earnings to issue share. Then retained earnings minus 25 million. That will go as ordinary share plus 25 million. 11th one, paid rupees 40 million VAT payable as at 1st of April to the Inland Revenue Department. Paid 40 million VAT payable. Then cash minus 40 million. VAT control minus 40. Next. Rupees 4 million for the personal income tax of managing director by the company. Managing director is an employee. Okay. When an employee's personal expense is paid, you can reimburse it back from the employee's salary. Okay. You don't just give things to your employee, right? Okay. It's like an advance which you will later deduct it from his salary. So 4 million for the personal income tax of manager, then cash will be minus 4. Okay, then what we will do later, we will cut it from his salary, and that will be an asset. Other receivable plus 4. We have to get it from the employee. We'll cut it later from his salary. Then 13th one. That is done. Then 13th one, paid 8 million income tax for this quarter calculated based on self-assessment basis. So cash and cash equivalent minus 8 million and expense under retained earnings minus 8 million. 14th one, provided 14 million depreciation of PPE for the quarter. PPE minus 14, expense minus 14. Okay. Then you can find the totals. That's all. Total is gonna be 600 plus 12 minus 14. That is 598. Inventory 220 plus 50 minus 70 plus 16 minus 2, 214. Trade and other receivables 60 plus 118 minus 29.5 minus 80 plus 4, 72.5. Cash and cash equivalent 130 minus 50 plus 75 minus 50 minus 13 minus 3 minus 40 minus 4 minus 8, 37. Bank loan 100 minus 40, 60. Trade payable 70 plus 59 minus 60, that is 69. VAT control 40 minus 9 plus 18 minus 4.5 plus minus 40, that is 4.5. And ordinary share 600 plus 25, 625. And retained earnings 200 plus 30 minus 9 plus 10 minus 5 minus 10 minus 1 minus 3 minus 2 minus 25 minus 8 minus 14, 163. That is done. Then the next requirement is to net profit, to find the profit, net profit based on retained earnings column. So under retained earnings, you will firstly have opening retained earnings. The profit will increase, the profit for the year. Okay. We can find it using this equation. Profit or loss equal closing retained earnings, okay, minus opening retained earnings plus, to reverse it, capitalization of reserve plus dividend paid plus dividend paid. Closing retained earnings was 163 million rupees million. Opening retained earnings was 200 million. To reverse the capitalization of reserve 25 million, dividend paid 0, then you can find your profit or loss 163 minus 200 plus 25. That's a loss of 12 million. Okay, so you can say loss rupees 12 million. This is the answer. Okay, so it's an easy accounting equation question. Alright. Then next, moving on to the NPO. NPO question, the requirements are to prepare the subscription account, prepare the income statement, and to find the total equity for the year. So then, starting off, they have given some opening balances. Now we have to first of all calculate the subscription account. Now here you have opening arrears. Only the opening arrears is given. BBF 30,000. Okay. The club has 60 members. The club has 60 members as of 31st March 2024. Of them, 10 are life members. Then only 50 ordinary members, right? Life membership is confirmed to the initial members of the club. Okay, the ones who made the club, the initial members. Life membership fee is recognized as income annually. So here you can see opening life membership fund is 400,000, closing life membership fund is 320. So the life membership fund have reduced by 80,000. So that life membership fund reduced by 80,000 only, you're recognizing it as a income. So you can say life membership income, life membership income 80,000. 80,000. Okay. The annual subscription per member is 12,000. Annual subscription could be paid in full at the beginning of the year or monthly on equal payment of 1,000. You can either pay it fully, 12,000 at the beginning of the year, or you can monthly pay 1,000 and go. The members are given a 10% discount if the annual subscription is paid in full. If you pay the full 12,000 at the beginning of the year, you're getting a 10% discount. Okay. If the annual, okay, at the beginning of the year, and the policy of the sport club is to recognize the net subscription received as the income. Okay, if someone pays the full amount at once at the beginning of the year, you will deduct the discount and recognize the net amount only as the income. There was a previous question like this in 2022 or something, where they said to recognize the discount separately as an expense. Here they are saying directly deduct the discount from the subscription income itself. Now we'll see. Now that's the policy. Now here they are saying who and who paid. Okay. 15 new members joined the club on 1st of April 2024. It is required to pay an entrance fee of 5,000 when a new member joins the club. During the year ending 31st March 2025, 40 members, including the new members, paid the annual subscription at once at the beginning of the year. Remaining members paid subscription on a monthly basis. 5 of these members paid subscription only for 9 months, and for balance and the balance members paid subscription for the full year. Subscription in arrears as at 31st March was received during the year. Okay. Now, right. Entrance fee. Now here entrance fee, they have not given any policy, right? And the entrance fee you can recognize as a income. Entrance fee. 15 new members are joining. It is required to pay an entrance fee of 5,000 when joining. So 5,000 into 15 members, that is 75,000. 75,000. Okay. Now we'll find the cash received from subscription. Subscription received. Okay. No. Okay. Now first of all, how many members do we have? 60 members. Out of that 10 are life members. Then there are 50 ordinary members as at the opening date. Then newly 15 members are joining. Then the ordinary members will be 65 members. 65 members. Now 15 members join the fourth club. It is required to pay an entrance fee. Okay. During the year, 40 members, including the new members, paid the annual subscription at once at the beginning of the year. So 40 members paid for the full year at once into 12,000. That is 40 into 12,000 is 480,000. But then when you pay at once, you're getting a 10% discount, that is 48,000. Then you're getting only 432,000 from them. 432,000. Okay. Then the remaining members paid a subscription on monthly basis. 5 of these members paid subscription only for 9 months. 5 members, they paid only for 9 months. That means 9,000 of a 1 month, 1,000 into 9 months, 9,000. That is 9,000 into 5, 45,000. 9,000 into 5, 45,000. Okay. And give me a minute. 5 into 9 months. 9,000, 45,000. Okay, then next. And the balance members paid for the full year. So balance members means balance members 65 members minus 40 minus 5 members, 20 members paid for the full year, but they paid monthly. Okay, not at once. Only for the ones who paid at once, you give a discount. Then 12,000 into 20, 240,000. 240,000. Okay. And then now 9 months, so that wait, this 5 members paid for 9 months. Then for remaining 3 months, they didn't pay no 3 months into 1,000 per month into 5, that is 15 members. That you can say here BCD closing arrears 15,000. Sorry, 5 members into 3,000, 15,000. Okay, and they're saying subscription in arrears as at 31st March 2024 was received during this year. This opening arrears of 30 was received. Opening arrears 35,000 was received. Then totally subscription received is total subscription received is 432 plus 45 plus 240 plus 35, 752. 432 plus 240 plus 45 plus 35, 752. Okay. Opening arrears 30, no? 30, sorry, 30,000. 432 plus 45 plus 240 plus 30, 747. 747. So then cash debit, subscription account credit, cash 747. And you can balance off and find how much is the amount to be transferred to the income and expenditure account. So income statement. 747 plus 15, 762. 762 minus 30, 732. So then income, subscription income will be 732,000. 732,000. Okay. Then next. The policy of the sports club is to recognize donation as income based on the total of the amount used and the amount committed to use. How much is used and how much is to be used. Okay. A donation received in a previous year to purchase sports equipment have been recognized as sport equipment fund. So here sport equipment fund, you have 800. Okay. The club purchased sport equipment costing 400,000 for cash during the year, and 300,000 was used from the sport equipment fund for this purchase. Okay. They have purchased sport equipment worth 400 for cash. Out of that, only 300 they have used from the sport equipment fund. Remaining 100 from the business's own money. Okay, from the organization's own money. Okay. A donation of two, okay. So then you can say there the policy is to recognize donation as income based on the total amount used. Next, you can say sport equipment fund used 300. Okay, you have to recognize that as income. A donation of 2 million was received to construct the indoor sports stadium has been recognized as building fund. Now that is, sorry, this is building fund. This is office equipment fund. Wait, office equipment fund 800. Sorry, sport equipment fund 800. Building fund 2 million. Okay. to construct an indoor sports stadium has been recognized as building fund. The sports club has paid a cost of 150,000 to develop the design of the stadium and commence the construction on 1st of March 2025. Okay. The first payment of 300,000 for the construction activities were payable as at 31st March 2025. So the used amount for the design is 150,000. The committed cost is 300. Okay, they have incurred, you have to pay that. Okay, the policy is to recognize the income based on the amount used and amount committed to use. So 300 plus 150 out of the building fund, you have to recognize totally 450 as income. Okay. Then the operating expense of the sports club has been calculated as 550,000. 550,000 for the current year. And it also includes an indoor sports stadium cost. Sports stadium design cost should be added to the cost of the sports stadium. It is not an expense. You have to capitalize it. Okay, according to LK 16, the design cost is added to the cost of that PPE. Okay. However, this do not include depreciation. Then you will have to calculate the depreciation. Okay, 550, 550 minus 550 minus the design cost 150. The operating expense will be 400. Operating expense will be 400. Operating expense 400. Now you have to calculate depreciation. Depreciation. See here. Um, okay. So now for PPE, you can prepare a small PPE account. Opening balance of the carrying value, PPE net book value, opening balance 1,500. You have during the year purchased office equipment worth 400, in total 1,900. Closing balance 1,350. Then you can find a depreciation here, 1,900 minus 1,350, that is 550. Okay, and depreciation of PPE, depreciation of property, plant and equipment 550. All right. Now your total income. Your total income will be 80 plus 75 plus 732 plus 300 plus 450. That is 1,637. Then your total expense is 950. Then your surplus will be 1,637 minus 950, 687. 687. Now you have to find your total equity. That's the next requirement, right? So firstly record opening accumulated fund. Opening accumulated fund. Opening accumulated fund is 900. For that you have to add the surplus. So here you can say rupees 1,000. You have to add your surplus. Surplus is 687. When you add that, you can get your closing accumulated fund. Closing accumulated fund. So 900 plus 687, that will be 1,587. Now for that, you have to add your other funds. Now you have life membership fund balance 320. Life membership 320. Okay, sport equipment, opening balance of the sport equipment fund is 800. Out of that fund, you use 300, and the balance will be 500. Sport equipment fund, sport equipment fund 500. And then finally you will have building fund. Building fund, you have got 2 million. Okay. Out of that, you have used 150 and 300, right? So 2 million minus 150 plus 300,000, remaining balance will be 1,550. Then you can find your equity as at 31st of March 2025 as 1587 plus 320 plus 500 plus 1550. That will be 3,957,000, your total closing equity. So then that is the third question. NPO and accounting equation is done. All right. So next, the fourth question. Question number 4A, prime entry book. Narada Traders commenced the retail business on 1st of January 2025. This business purchases goods only on credit basis and sells goods on both credit basis and cash basis. Okay. The business is registered for VAT. The following transactions have been carried out by the business during the month of January. Okay. They have given a few transactions and then additional info and then the requirements, right? Requirements, you need a cash receipt journal, cash payment journal, sales journal, purchase journal, and general journal. In the general journal, you will record all the transactions that are not recorded in any of these prime entry books. And then you have to prepare a separate general journal to record the totals of the prime entry books. And then 3 accounts, namely cash, VAT, and bank loan account. Okay. And starting off with the first one, the owner invested 200,000 in cash and a furniture worth 480,000 as capital. So then the owner investing 200,000 in cash should be recorded in the cash receipt journal. So on 1st of January, you can say capital. How much was that? 200,000 in the other column. 200,000. Then next, obtain the bank loan of 600,000 at an annual interest rate of 12%. So here obtained a bank loan of 600,000. So the bank loan, wait, other thing, furniture. So owner invested cash and furniture. The furniture investment will go to the general journal. That will be 1st of January. Furniture account debit 480,000. Capital account credit 480,000. You can say narration, recording owner's investment of furniture. You can say this as your narration. Then obtain the bank loan of 600,000 at an annual interest rate of 12%. So the bank loan will go to the cash receipt journal on again 1st of January. Bank loan that is 600,000. Here you should write the amount in amount column as well. 600 and it will go to the other column. Then on 5th of January 2025, purchase goods for 472 from Dasun on credit, including 72,000 VAT. That will go to the purchase journal. So on 5th of January, purchase journal, purchase of goods worth 472 from Dasun. So you can say Dasun. The VAT is 72. The total amount including VAT is 472. Then the purchase value will be 400. Then Sold goods for 118,000 for cash. That will go to the cash receipt journal. On 12th, sorry, on 7th of January, sales 118, including VAT 18, then the sale value will be 100. Sales value will be 100. Then sold goods for Binara for 236 on credit. So you go to the purchase sold no on sales journal 12th of January 12th of January sold goods to Binara sold goods to Binara for 236 total including a VAT of 36, then the sale value will be 200. Sale value will be 200. Okay. Then next, on 15th of January, purchase goods for 531 from Arun on credit. So on 15th of January, you are purchasing from Arun for 590, including VAT of 90. Then the purchase value will be 500. Next. Receive the full amount due from Binara. Binara should pay 236. In cash receipt journal, you're gonna say on 22nd of January, Binara 236, under data also 236. Received, settle the full amount due to Dasun after receiving a discount of 10,000. Now we have to pay Dasun 472, but if we are getting a discount, okay, Dasun 25th, 25th of January, you are paying to Dasun. You're getting a discount of 10. You have to totally settle him 472. If you're getting a discount of 10, you have to give him only 462. It will go to the creditors column. Then paid 140,000 for operating expense. 28th of January. Operating expense 140,000. You put it to expense column. Then the bank loan. Paid the monthly bank loan installment of 13,000, including 6,000 interest. Okay, so now remember the monthly bank loan installment. Earlier we used to divide it as the interest in the expense column and the what? And the loan portion in the other column. But then in the 2025 marking scheme, there is a change. Okay, you're supposed to do it like the lease adjustment. You're going to record the entire installment amount in the bank loan account, and after that, you will remove your interest amount through the bank loan account itself. So, how you're going to do that? 31st of January, you're going to write here bank loan, and you're going to record the entire installment of 13,000 in the bank loan account. Okay. After that, the interest you will do it as an adjustment. Okay. Now, interest is an expense. Interest expense is debit. Okay. That interest will be included in the installment, right? Now, you debited the entire installment to the bank loan account. Then to remove the interest from that, you will have to credit the interest to the bank loan account. So the double entry will be 31st of January, bank loan interest debit, bank loan interest will be debited by 6,000. You're going to credit it from your bank loan account. So this is an adjustment here. 6. You're going to say recording of bank loan interest. Okay. Finally, the additional info. The furniture is available for use from 1st of January 2025. Its estimated useful life is 5 years and residual value is 0. Now, the furniture value is 480,000. divide it by useful life of 5 years, the annual depreciation is 96,000. Now here we are preparing the prime entry book for the month of January. Then you divide it by 12 for 1 month, the depreciation will be 8,000. And you can say here furniture depreciation debit 8,000, accumulated depreciation credit 8,000. You can say recording of furniture depreciation. So the first requirement is done. Now we have to total all of it. Okay, so we have to total. Then there is, you can say here 31st of January. You have to say this posted to ledger, discount allowed 0, total amount 200 plus 600 plus 118 plus 236, that is 1154. Sales will be 100, debtor 236, other 800, VAT is 18. Then cash payment journal 10, 462 plus 140, that is 602. Creditor 462, expense 140, other 13. Then sales journal was the only one. Did I miss anything? I haven't recorded this, no? Sandun. Where did I record that? Okay. Here, purchase goods for 531 from Arun. Arun, it is 531. 531, including VAT of 81. Then the purchase value will be 531 minus 81, 450. Then Sandun's one will go here, 20th of January, Sandun, 590, 590. Okay. Then totals will be 700. You're supposed to say here also 31st of Jan, posted to ledger, posted to ledger. Then here also you're supposed to say 31st of Jan, posted to ledger. Okay. 90 plus 36, that is 126. 236 plus 590, 826. Then next, here 31st of January, posted to ledger, 400 plus 450, that is 850. The VAT will be 72 plus 81, that is 153. And the total will be 472 plus 81. Yeah, that will be 472 plus 531, 1003. 1003. Okay. Ten 600 and yeah, I didn't add the bank loan amount. 615, 462, 140, 13. Then 700. Okay. Then that is done. Now you have to post the totals of the prime entry book to the general journal. So then cash receipt journal total. Sales. Now here everything you're getting cash. You're totally getting cash of 1,154. And you're gonna say here cash control account, debit. Okay, now your cash will increase totally by 1,154. I mean 1,154,000. Then sales account will be credited by 100. sales account credited by 100, debtors account, debtors control account will be credited by 236. In other column, you should show separately capital account and bank loan account. Capital account credit 200,000. Bank loan account credited by 600,000. And here sales the VAT 18. VAT will be credited by VAT control account will be credited by 18,000. So what you're gonna say here, posting posting of the totals, posting of the totals of cash receipt journal to ledger, to the ledger. Okay, that is done. Then moving on to the next one, the cash payment journal. In cash payment journal, the cash is going out. Okay, the cash will be credited. All the other accounts will be debited. So then creditors account debit, creditor control account debit 462, operating expense debit 140, and bank loan account will be debit by 13. Totally cash control account will be credited by the total amount 615. So here you can say posting the total of cash payment journal to ledger. You can also say posting journal entries for the totals of the cash payment journal. That is also fine. And this is done. And then the discount received amount, you should separately show it. Okay, you're gonna say creditor control debit. How much was that? 10. Discount received credit 10. Okay, then if there's a discount allowed below the cash received journal totals, you need to show that as well. So you're gonna say posting the discount received to ledger. Then that is done. Then next you have the sales journal and purchase journal. So sales journal total, how will you record it? Debtors debit, sales and VAT credit. So debtors account, debtors control account debit by the total amount. Your debtors value will increase by 826. Debit 826. VAT control will be credited by 126. Sales will be credited by 700. You can say here recording, or you can say posting. You can say posting, posting the totals of sales journal to ledger. Okay, and then next, the purchase journal. Finally, the purchase journal. Purchase journal, you have to record it like this. Purchases is expense, so purchases debit. Purchases will be debit. VAT, purchase VAT is an asset, so VAT control will be debit. and the total amount will be credited to the creditor's account. Okay, creditor is a liability. So purchase 850, VAT 153. 850, 153. Total amount you will credit to the creditor 1003. So you can say here posting totals of purchase journal to ledger. And that is done. Now you can prepare the three accounts: cash control account, VAT control, and bank loan account. So in cash control account, you can say sales 100. Here you can post it from here. Sales 100, debtor 236, capital 200, bank loan 600. Now you have a bank loan account, right? In bank loan account, you can say cash 600 credit. Okay. And then VAT control 18. Then you can credit it to the VAT saying cash 18. Okay. Then next, creditor control account operating the cash payment channel. So you can say here creditor 462, operating expense 140, bank loan 13, and this you can debit to the bank loan account saying cash 13. Next, the discount allowed and received, there is no place to record. You don't have a credit account or discount received account. Then here debtor control account debit 826, VAT control credit. So here you can say debtor 126. Okay, sales account is not there. Then the purchase VAT 153 you can debit here saying creditor 153. And then now what you should do for the interest, this interest amount, okay, bank loan interest account debit, bank loan account credit. So you are going to remove the interest that's included in the installment saying interest 6,000. Okay, now you can balance off this account. Total of the debit side will be 100 plus 236 plus 200 plus 600 plus 18, 1154. 1154. If you deduct the values in the credit side, minus 462 minus 140 minus 13, that will be 539. In the VAT account, the debit side is higher, 153, 153 minus 126 minus 18, balance carried down will be 9,000. And the bank loan account, 606 minus 13, 593. 593. So then that is all about the prime entry books. Here the cash receipt journal, payment journal, sales journal, purchase journal, general journal to record the transactions, then the general journal to record the totals of the prime entry book, and then the three accounts: cash control account, VAT control account, and bank loan account. Okay, so then that is done. Then moving on to the next part of it, the investment appraisal question. So B part, a manufacturing company is considering a project to replace the existing machine with a high-end, high-tech machine. The new machine is expected to use for a period of 5 years. The following estimated information is provided in this respect. Okay, purchase price of the new machine 11,000. It will be an outflow in the initial investment, year 0. You can say purchase price 11,000. Then next, installation and transportation cost of new machine. Installation and transport. Installation and transport cost, that is 1,000. Okay. Next, additional working capital requirement 2,200. You can say working capital requirement 2,200. Selling price of old machine 1,200 will be initial outflow. Selling price 1,200. Then carrying amount of old machine, you don't need it. Tax payable on the gain on the sale of old machine 250. When you're selling that old machine and get a profit, disposal gain out of it, you're supposed to pay a tax for it, that is 250. And that will be a outflow. Tax on machine 250. 250. Okay, that is done. Then a residual value you will need if you want. Residual value will come as an inflow in the final year. Residual value can be recovered in the final year. Residual value 2,000. Additional info. The additional working capital can be recovered fully at the end of the project. Then you can say working capital recovery. Working capital recovery 2,200. Okay, next. If the new machine is purchased, the expected annual cash inflow in year 1 is 5,000. And thereafter, this amount will be increased by 10,000 each year of the project. Okay, it will keep on increasing by 10,000. So then, annual cash inflow. Annual cash inflow will be, so the revenue. Year 1, it will be 5,000. Then year 2, it will be 5,000 multiplied by 1.1. Okay, that means if you want to increase by 10%, 1.1, it will be 5,500. That one, if you multiply by 1.1, 6,050. Again, if you multiply by 1.1, 6,655. And again, if you multiply by 1.1, 7,320.5. So why 1.1? That is like 5,000 into 110% over 100. You're adding a 10% extra to the existing cash flow, right? That's what. So if you simplify this, it's going to be 5,000 into 1.1. Okay. So you keep on multiplying by 1.1, it will give the annual increase. Okay. Next. Income tax rate of the company of the annual on annual profit is 20%, and the income tax should be paid at the end of each year. The required rate of return of the project. Sorry, wait, I have missed this. The expected operating expense of the project, including depreciation, is as follows. So they have given the operating expense including depreciation. We need to record the operating expense excluding depreciation. Operating expenses excluding depreciation. Now we'll calculate the depreciation. Depreciation equals cost of the asset minus residual value divided by useful life. So the cost of the asset, you have to take the purchase price. Purchase price is 11,000. And in LK16 we studied installation and transportation cost also should be added to the cost of the machine. That is 12,000 minus residual value 2,000 divided by useful life 5 years. The annual depreciation is 2,000. So you can remove the depreciation 2,000 from operating expense and record the cash expense. How much of expense is paid in cash? Okay, you can assume only depreciation is the non-cash expense. Then if you remove depreciation from this, 2,900 minus 2,000, that's gonna be 900 for year 1. Then for year 2, again 2900 minus 2900 for year 2. Then for year 3, it's going to be 2950 minus 2000, that's going to be 950. Then year 4, it's going to be 1050. And year 5, it's going to be 1120.5. 1120.5. Now you have to find your tax expense of each year. Okay. Income tax rate of the company on annual profit is 20%, and income tax should be paid at the end of each year. Now you have to find your income tax. Now here, your revenue will be the annual cash flow inflows, right? You have to prepare the income statement of each year and find out how much is the tax. So the annual cash flow of each year will be 5,000, that you can take as revenue. 5,000, 5,500. Then you have 6,050, 6,655. And for year 5, you have 7,320.5. 7,320.5. Now, when you're finding the profit, you can deduct the entire operating expense, including depreciation. 2,900, 2,900, 2,950, 3,050, 3,120.5. Then you can get your profit before tax. 5,000 minus 2,900, that is profit before tax 2,100. 5,500 minus 2,900, 2,600. 5,050 minus 2,950, 3,100. 6,655 minus 3,050, 3,605. And for year 5, 7,320.5 minus 3,120.5, that will be 4,200. Now the income tax is 20% on profit before tax. Okay. The here 20% of 2,100 will be 420. Here it will be 2,600 into 20%, 520. Then 3,100 into 0.2, 620. 3,605 into 20%, 721. And for year 5, 4,200 into 0.2, 840. Then profit for the year you can find and keep, because later they are telling to find the ARR, right? So profit for the year, you can find it and keep 2,100 minus 420, that is 1,680. Here 2,600 minus 520, 2,080. 3,100 minus 620, 2,480. And here 3,605 minus 721, 2,884. And for year 5, 4,200 minus 840, 3,360. Now what you have to do now, this income tax is being paid every year, and then you have to record it as a cash outflow. You're going to say income tax, okay. Income tax 420, 420, 520, 620, 721, and 840. Okay. So now you can, all the cash flows are recorded. You can find your total net cash flows. So year 0, total inflows 1,200, year 1, 5,000, 5,500, 6,050, 6,655, and for year 5, 2,000 plus 2,200 plus 7320.5, that is 11,000 11,520.5. Okay. Then total outflows will be, you can put within bracket, 11,000 plus 1,000 plus 2,200 plus 250. That will be 14,450. Year one, it's gonna be 900 plus 420, 1,320. Then here 1,420, 1,570. Then 1,771 and 1960.5. Then the net cash flow will be for year 0, 1,200 minus 14,450, that is minus 13,250. Year 1, 5,000 minus 1,320, that is 3,680. Year 2, 5,500 minus 1,420, that is 4,080. Year 3, 6,050 minus 1,570, that is 4,480. Year 4, 6,655 minus 1,771, that is 4,884. 11,520.5 minus 1,960.5, that is 9,560. Okay. So these are the net cash flows. Net cash flows. Okay. Then next, that's the first requirement, right? First requirement to estimate the initial and annual cash flows done. The net present value. Next, we'll find the net present value. Now you can continue and record the discounting factor, multiply that with the net cash flow and get the present value in the same table. Because I don't have space, I'm showing it separately. Even if you're showing it separately in the second separate requirement, that is also perfectly fine. So rupees 1,000. Year 0 net cash flow is 14,450, 13,250 negative. Year 1, 3,680. Year 2, 4,080. Then year 3, 4,480. Year 4, 4,884. Year 5, 9,560. Now the discounting factor always for year 0 is 1. Okay, that means 1 rupee today will always be equal to 1 rupee today, right? That will not change. Then year 1, it's going to be 0.89, 0.80, 0.71, 0.64, 0.57. And when you multiply this discounting factor with the net cash flow, you can get the present value for each year. So for year 0, present value will be equal to the cash flow amount. For year 1, 3,680 into 0.89, that will be 3,275.2. Then here 4,080 into 0.8, 3,264. Then year 3, 4,480 into 0.71, 3,180.8. Then for year 4, 4,884 into 0.64, that is 3,125.76. And for year 5, 9,560 multiplied by 0.757, that is 5,544.8. Okay. Then you can find your net present value. Add all the positive present values. First, 3,275.2 plus 3,264 plus 3,180.8 plus 3,125.76 plus 5544.8. Okay, after adding all the present values, you can minus the initial year zeros minus negative value, the minus initial net cash flow 13,250. If you deduct that from the present value of year 1 to year 5 total, you will get your cash, your net present value as, give me 3275.31 3680 into 0.89. Okay. 3180, 31265549. Okay. 3275.2 plus 3264 plus 3180.8 plus 3125.76 plus 5544.8 minus 13250. Yeah, so here 9560 into 0.57, that's gonna be, here there's a mistake, it should be 5449.8. 9.2. 9.2. Okay. So 5449.2 plus 3125.76 plus 3180.8 plus 3264 plus 3275.2 minus 13250 is gonna be 50. The NPV, the net present value is gonna be 5044.96. You can round it off and write it on 5045. Okay, that is also fine. So that is done. Then next, NPV is done. This is the second requirement. Then the third requirement, you can say, since the project generate a positive NPV, it is recommended to invest. You can simply say like this, you're going to get 1 mark for that. Then the fourth one, the accounting rate of return of the project based on average investment. ARR equals to average profit divided by average investment into 100. First of all, average profit. How do you get the average profit? Average profit equals total profit divided by number of years. Total profit will be equal to, now here we calculated the profit, now add all of it, 1680 plus 2080 plus 2480 plus 2884 plus 3360, that is 12484 divided by number of years, 5 years, next totally 5 years. Average profit will be 2496.8. Okay, so 2496.8 divided by average investment. Average investment will be equal to initial investment plus residual value divided by 2. Now here for initial investment, you will only take the cost of the asset. The cost of the asset is 12,000, right? Purchase price 11 million plus installation cost 1 million. Okay, that together, like when we are calculating depreciation, we took 12,000. That only you will take here 12,000, the initial value of the machine. And then the value of the machine at the end of the useful life, the residual value, that is 2,000 plus 2,000 divided by 2, you are going to get 7,000. So divide by 7,000 into 100. ARR is 2496.8 divided by 7000 into 100. That is going to be 35.67%. You can round it off and tell like this. Okay. Then that is the fourth question. It's a good investment appraisal question. Could be time consuming. Okay. And that is done. Then moving on to question number 5. Balan and Sheelan were partners of a retail trading business. They shared the profit and losses equally. Okay. These partners agreed to improve the business by admitting two new partners, Deepal and Emil, on 1st of April 2024. The terms of the new partnership agreement are as follows. Profit and losses are shared among Balan and Sheelan, Deepal and Emil in the ratio of 2:1:1 respectively. Partners are entitled to receive 10% interest. Each partner is entitled to annual salary of 1,200,000. Okay. And they are saying, and it can be settled either by paying cash or by giving trading goods of the business at cost. So then the partners agreed to apply the provisions of the Partnership Ordinance of 1890 for the matters that are not covered in the agreement. Okay. So now, first of all, you can start off with additional information one. Now here what's happening, there are two new members who are joining in the beginning of the year. So you can record the partner's capital account and current account with 4 columns. Current account. Okay, so it was not a hard question. So here you can start it with the firstly record the opening balances of the current and capital account. So current account opening balance of Balan and Sheelan are 600 and 400, and the capital account 4,000 and 4,000. Okay. BBS 4,000, 4,000, and here BBS 600 and 400. Then asset brought by Deepal and Emil on 1st of April 2024. So Deepal have brought land of 3 million, Emil have bought trading inventory of 4 million, and both have bought cash 2 million and 1 million. So then you're going to say land. For trading inventory, you will debit it to purchase account, purchase and cash. Balan brought a land of 1 million, 3 million, 3 million. No, wait, who was that? Deepal. Deepal brought a land of 3 million. Emil brought trading goods worth 4 million. And both brought cash, right? 2 million and 2 million and 1 million. 2 million and 1 million. Okay. Then that is done. Then next, only the cash brought by both the new partners and the trading inventory brought by Emil have been recorded in the books. The land given by Deepal has not been recorded in the books. The land given by Deepal is used as a parking area for the business, while the inventory given by Emil has been taken to the showroom for trading. Okay, so they have not added the land to the cost of the PPE. That's what they are saying. All right. Then second one, done. Third one. On the date the new partners were admitted, the goodwill of the partnership was estimated as 2,400,000. However, no entry has been made. So goodwill, based on the new ratio, it will be debited. New ratio is 2:2:1:1. And based on the old ratio, credit. Old ratio, Balan and Sheelan, they shared profit and loss equally, 1:1. So the goodwill amount is 2,400 If you are dividing equally based on old ratio, 1200 and 1200. Based on new ratio, 2400 divided by 6 into 2, it will be 800, 800, 400 and 400. Done. Then next, salary payment for the partners during the year are as follows. You're paying salary as follows, okay? 1200, you're paying in cash as well as in goods, right? So then you can say here, paid in cash and in goods. Goods now, you're taking it from the purchases account. All right. So in cash, you're paying 1200, 800, 500, and 400. 1200, 800, 500, and 400. And then you're also paying by giving goods. So to settle the salary, you can give anything. They're saying you can either pay cash or trading goods. So you're giving goods of 200 and 100 to Deepal and Emil. 200 and 100. Okay. Then next. The salary paid to the partner in cash have been recorded as admin expense, and issue of trading goods to settle salary have not been accounted for. Now the salaries paid in cash to the partners have been recorded as an administrative expense. Then what you have to do, okay, here in the trial balance you can see admin expense, admin expense, admin expense is given as 8,000. And from that 8,000, you have to remove the salary paid in cash, 2,900. They're saying the salary paid in cash is recorded as a admin expense. So you have to deduct 2,900 from that, minus 2,900. Okay. Then that will be 8,000 minus 2,900, 2,100. Then next, that issue of trading goods to settle salary have not been accounted for. Now they are taking out the trading goods out of the purchases, right? Okay, then you have to remove it from your cost of sale. Here the closing stock inventory has been ascertained based on physical stock available. So that means closing stock, they are going to the warehouse and only calculating. So if a good is taken out, you have to deduct it. Okay. Now from the cost of sale given 8,000, you have to deduct, okay, the 300 goods given to the partners. Then that cost of sale will be 8,000 minus 300, 7,700. 7,700. Okay. Then next, Deepa cleaned the land given by the given to the business by incurring an expense of 50,000 using his personal funds. This expense has not been accounted for. Then cleaning expense, you can record it here. You can add it to the admin expense if you want by showing a working or show it separately. Cleaning expense 50,000. Now, when a partner pays the expense by his own money, it will be credited to his current account. You can say cleaning expense 50 Deepal, 52 Deepal. Then next, Sealan was sent for a management training program conducted in India. The entire cost relating to this training, rupees 300,000, was borne by Sealan from his personal funds. The partner agreed to reimburse this amount to him and consider it as an expense of the partnership. Now, the Sealan's training expense is an expense of the partnership, not his personal transaction. He paid it out of his own money, okay? And he is supposed to get it back from the partnership. Now they have not recorded this thing. Then you have to you have to record it here. Training expense, training expense. How much was that? Training expense 300,000. And you're supposed to record it in the current account saying training expense Sealant 300,000. Okay. Then the partnership paid 120,000 as fire insurance premium for the current year. This amount has been recorded in the admin expense. This insurance premium also includes 20,000 paid for the fire insurance of Emil. So you have to remove another 20 from here. Minus 20. Minus 20. And here it's gonna be, wait, here it's going to be 8,000 minus 2,900 minus 20. 5,080. 5,080. Okay, that is done. Then you have to record it here. Fire insurance, Emil 20. Then next, sorry, that is done. Then we'll record all other things. Sales revenue 30,000. Sales revenue 30,000. Cost of sale done. Admin expense done. Distribution and other expense. Distribution and other expense, that is 3,000. That is 3,000. Okay. Then next, cash, we don't need. Inventory, PPE, loan given by Balan 2,000. And we didn't come across any interest, right? Then if they are silent, we have to give 5% based on section 24. 5% of 2,000 is 100. Then you can say loan interest to Balan, that will be 100. And you have to record it in the current account credit side of balance. Okay. Loan interest 100 to balance. All right. Then next, that is done. Current account balance, capital account balance, all adjusted. Cash brought by Deepal, cash brought by Emil, and the trading inventory brought by Emil, all adjusted. Okay. Then now you can find your profit. Gross profit will be 30,000 minus 7,700, that is 22,300. Your total expense will be 5,080 plus 50 plus 300 plus 3,000 plus 100, that is 8,530. Your net profit will be 22,300 minus 8,530, that is 13,770. 13,770. Now you can provide interest on capital. Interest on capital, what are they saying? Partners are entitled to 10% interest per annum on the year-end capital balance. Year-end, then you have to balance off your capital account. 5,200, 5,200, 5,000, 5,000. 5,200, 5,200, 5,000 and 5,000. BCD will be 5,200 minus 800, that is 4,400, 4,400, here 4,600, 4,600. Then interest on capital will be 440, 440, 460, 460. And total interest on capital is 1,800. Then the remaining out of the profit will be 13,770 minus 1800, that is 11,970. Now every partner is entitled to a salary of 1,200. So 1,200, 1,200, 1,200, 1,200, totally that will be 4,800. Then the distributable profit will be 11,970 minus 4,800, 7,170. Now you have to divide this based on the profit share 2 is to 2 is to 1 is to 1. So divide by 6 into 2, 2,390, 2,390, 1,195, 1,195. Now you have to record this interest on capital, partner salary and profit share in the partner's current account. Okay. Interest on capital. Interest on capital was 440, 440, 460, 460. Then you had partner salary 1,200, 1,200, 1,200, 1,200. Then you had the profit share. Profit share was 2,390, 2,390, 1,195, 1,195. Now you can balance off the current account. Okay. You can balance off the current account. 600 plus 100 plus 440 plus 1,200 plus 2,390, 4,730. 4,730. Then 400 plus 300 plus 490 plus 1,200 plus 2,390. That is 4,780. Well, 400 plus 300 plus 440 plus 1,200 plus 2,390. 4,730. That was a 4,730. Then 50 plus 460 plus 1,200 plus 1,195, that is 2,905. And Emil 460 plus 1,200 plus 1,195, 2,855. Then you take it to the debit side. 4,730, 4,730, 2,905, 2,855. Then you can get your BCD, balance carried down. 4,730 minus 1,200, that is 3,530. 4,730 minus 800, 3,930. 2,905 minus 700, 2,205. And finally 2,855 minus 520, totally 2,335. 2,335. So then that's the partnership question. This is your income statement. This is your capital and current account. Okay. Then moving on next to the ratio question of the same thing. All right. First of all, you need to find the profit after tax of Gihan PLC. Profit after tax, how do you find? Okay. Here total equity is given. Now you can find it through your return on equity equation. So we know, okay, first requirement, return on equity equals to profit after tax divided by equity capital into 100. Now here, return on equity is given as 15%. Profit after tax, we don't know. Equity capital is given as 24,000. 24,000. into 100. And how much will be profit after tax? That will be 15 into 24,000. This 24,000 you take to other side as multiplication and 100 will go to other side as division. That will be 15 into 24,000 divided by 100. That will be, now these are in thousands, then it's gonna be rupees 3,600,000. Okay, so it's gonna be, wait, it's in thousands, we'll write the full value then. 2,400,000. 2,400,000. Okay. Then the second requirement, there are 5 sub requirements. Dividend per share equals to dividend paid divided by number of shares. Dividend paid, how do you find? Dividend paid, dividend paid. Where they're asking for the dividend per share. Dividend per share equals to dividend paid. Where's the dividend paid? So here the company has paid 800,000 dividend for the current year, and there are 2 million number of shares. Okay. Then it's gonna be 800,000 dividend paid divided by 2 million shares. It's going to be rupees 0.4 per share. Okay. Then Roman number 2. Next, what we have to find, current ratio. Okay. Current ratio equals to current asset is to current liability. Okay. Now here, current asset, they have not given directly. No, current asset is not given directly. Okay. Here see, you can find the current liability now. Debt to equity ratio is 0.6. Okay. Debt to equity. All right. Now here, equity capital is 24,000. Okay, if they are saying debt to equity ratio is 0.6, that means your debt capital is 0.6 times of your equity, then your debt will be 0.6 into 24,000, that is 14,400,000. Now, if your total liability is 18 million, from that if you deduct, now debt capital means your non-current liability, and current liability equal total liability minus non-current liability. Total liability is 18 million minus non-current liability 14,400,000. 14,400,000. Then your current liability will be 18 million minus 14,400,000, that is 3,600,000. Okay, 3,600,000. In current asset, they have given the component separately. You can add and find it. Inventory plus trade debtor plus cash, 3016 plus 2580 plus 164, that is 5760. Okay. You can show those as workings. All right. Nicely. How do you find current liability to what? No? 576. Then 5760 divided by 3600, it's going to be 1.6 is to 1. That's your current ratio. Then the third requirement, debtor turnover ratio. Debtors turnover equals to credit sale divided by average debtor. Average debtor. Credit sale, credit sales are how much? How do you find that? All sales of the company are made on credit. All the sales are made on credit section. Okay. Cost of sale is given. Now you have to find your sales indirectly. Okay. You have to find your sales indirectly. Now you know your profit. Okay. Sales minus cost of sale, you will get gross profit. From the gross profit, if you deduct operating expense and interest expense. Now operating expense means profit, what? Distribution, admin and other. You will get profit before tax. From that, if you deduct the tax expense, you will get profit after tax. Now profit after tax 3,600,000. Okay, you can show this working nicely. 3,600,000. Then the income tax, the tax expense is 1,080. Then the profit before tax will be 3,600,000 plus 1,080, 4,680. Now interest expense is 720, operating expense is 2,720. Then if you reverse and go, gross profit will be 4,680 plus 720 plus 2,720. That will be 8,120. Okay. Now from that, now cost of sale is 15,018. Then when you reverse it, 8,120 plus 15,080, sales will be 23,200. Okay. This is how you are going to find the sale. Okay. Is there any other way to find sale? Probably. Okay. Yeah, I mean, you can find sales this way. So sales is 23,200. 23,200. And now, next. Now here, this is a newly started business, right? When you have a newly started business, you don't have opening data balance. Therefore, you can take your closing data balance. And now here they are also saying in the question to calculate data turnover ratio based on the year-end data balance. Year-end data balance is 2580. 2580 divide by 2580. Then you will get your answer as 23,200 divided by 2580, 8.99 times, 8.99 times. Okay. And the fourth one is asking you for inventory residence period. Inventory residence period equals to average inventory, so average stock divided by cost of sale multiplied by 360. 360. Now here they are not telling to take average stock, year-end inventory balance. Okay, when there is, remember, whenever the opening stock or opening stock are zero, and when they ask for this data turnover inventory residence period, you're going to take the closing balance, not the average. Okay, closing stock is 3,016. 3,016. 3,016 divided by cost of sale is 15,080. 15,080 multiplied by 360. So 3016 divided by 15,080 into 360, that is 72 days. 72 days. Okay. Then next, I think the last one, gross profit ratio. Fifth one, gross profit ratio equals gross profit divided by sales into 100. Earlier we found the gross profit, right? Earlier we found the gross profit through this working 8,120. 8,120 divided by sales is how much? Sales is 23,200 divided by 23,200 into 100. So 8,120 divided by 23,200 into 100, that is 35%. Okay. Then the last requirement, indicate the name of the company for each of the following situation with the reason by comparing the ratios calculated in part 2 above with the given ratios of Castun. Now here they have given now the following ratios of Castun PLC, a competitive company of Gihan PLC. Now we calculated ratios for Gihan PLC. Now here they have given the ratios of the competitor Castun PLC. Now we have to read this and put the relevant company and give the reason. Number one, the company that maintains a higher profit ratio on sale. Now see here, Castun PLC gross profit ratio 32%. Now we are Gihan PLC, we found 35%. Then who has a higher profit ratio on sale? That is, now you can say requirement number 3, Roman number 1, Gihan PLC. You can say has a higher or earns a higher gross profit ratio. Second one. The company that has a higher ability to settle short-term liability, then you have to look into the current ratio. Kasun's current ratio is 1.8, while Gihan's current ratio is 1.6. Then Kasun's current ratio is higher, right? Then Kasun has a higher ability to settle short-term liabilities. You can say has a higher current ratio. Third one. The company that is more efficient in collecting cash from debtor. You have to see the debtor turnover. Now, debtor turnover of Kasun is 5.5. Debtor turnover of Gihan is 8.99. Then Gihan has a higher ability to get the cash from the debtor. Here 8.99 times. That means you can during the year you can get around 8.99 times cash from your debtor. So that is Gihan PLC has a higher debtor turnover ratio. How much times on average are you recovering cash from your debtor? Fourth one, company that sells inventory within a shorter period of time. Then you have to find the inventory residence period. Kasun is taking 80 days to sell inventory, while Gihan is taking only 72 days. Then again, you're going to say Gihan PLC, and you're going to say has a lower inventory residence period. Then the fifth one, the company that retains a higher portion of profit for future investment. Now see here, Kasun is paying 0.3 rupees per share, while Gihan is paying 0.4 rupees per share as dividend. Then who is keeping money for the business? They're saying the company that retains a higher portion of profit for future investment. Which company keeping profits in their business to invest in the future without giving dividend? Much. So see, that is Kasun, right? Kasun is giving less dividend per share compared to Gihan. Then they are only retaining more profit. That is Kasun PLC has a lower dividend per share. Okay, and that is your fifth question, partnership and ratios. All right. Then moving on to the sixth question. The following information has been extracted from the books of the company for the preparation of statement of cash flows of Dilan PLC for the year ending 31st March 2025. So here they are given a few transactions, and then you can go to additional information directly, and there you have some extracts of current liability and current assets. Then certain additional information, credit sales for the year ending is 31st March, for 31st March 2025 were 32 million. Now here they have given the cash sale. So cash sale, now here they are telling first of all to prepare the cash flow statement on direct method, okay? Using the direct method to show the cash flow resulting from operating activity. So cash sale, you can record it as operating activity. Cash sales 36,500. Then now for credit sale, you can prepare the debtor account and find out how much is the cash you paid to your debtor. Okay, so you can open a debtor account. Debtors opening balance BBF of the debtor is 10,750. 10,750. Okay, and then the credit sale amount is 32,000. Closing debtor balance is 9,500. Then you can balance off and find how much is the cash received from debtor. Okay, that's gonna be 10,750 plus 32,000, 42,750, 42,750 minus 9,500, 33,250, 33,250. Cash 33,250, that will be an inflow. 33,250. We are going to say receipt from debtor. Receipt from debtor. Then next, okay. Then next, you can find the purchases. Okay, how much was paid to creditor. Now here you have cost of sales. Through cost of sale, you can find the purchase. Okay, opening stock. Opening stock plus purchases minus closing stock will give you your cost of sale. Now here we don't know whether we have cash purchase, credit purchase. They have not told. So take your opening stock as 6,500. Closing stock is given as 8,000. Cost of sale is given as 36,500. And indirectly you can find your purchase. 36,500 plus 8,000 minus 6,500, that is 38,000. Now you don't know how much is cash and credit purchase name. You take the entire amount and put it as a credit purchase. Okay. In the creditors account, you can say BBF, BBF, BBF of creditor 6,250, BCD 4,750. Okay, and you can say here purchases 38,000. So then 38,000 plus 62, 6,250, 44,250, 44,250 minus 4,750, that will be 39,500, 39,500. Here you can say, okay, for this you can say cash purchase. Now you don't know how much is the cash purchase, Now for this cash amount paid to creditor, you can say cash purchases and payment to creditor together. Payment to creditor 39,500. 39,500. Then next, okay. So inventory adjusted, trade receivable adjusted, trade payable adjusted, your cash sale, cost of sale adjusted. Next, what you can do, accrued operating expense, you can find out how much is the operating expense paid. Okay, operating expense. Opening accrued operating expense, operating expense for the year, cash paid, BCD. Opening operating accrued operating expense is 600, closing is 1000. The operating expense for the year is 10,000. Then you can balance off and find how much is the operating expense paid. 600 plus 1000, 10,000 is 10,600. 10,600 minus 1000, that is 9,600. So then here you can get here there is a depreciation expense of 4,500,000 and discount allowed of 500. So discount allowed should be posted to the debtors account, right? Discount allowed 500. Then the actual amount received in cash will be 32,750, right? 32,750. And here it should be 32,750. Okay. Cash purchase and payment to creditor minus 39,500 minus 39,500. Then creditors account opening 6,250, closing 4,750. Purchase value is how much? 36,500 plus 8,000 minus 6,500, 38,000. All right. So that is 39,500. Operating expenses, now including depreciation and discount allowed, no 10,000. You should remove the non-cash items. Depreciation 4,500 and discount allowed 500, totally 5 million. Then here you can take 5,000. 5,000. Then 5,600. 5,600 minus 1,000, that will be 4,600. Okay. Operating expense paid will be 4,600. Okay. Then sorry, and here another mistake. The cost of sale is 30,000, not 36,500. Then the purchases amount will be 30,000 plus 8,000 minus 6,500, that is 31,500. Purchases will be 31,500. And when you balance this off, let me erase it. Purchases value 31,500. The closing creditor balance is 4,750. Then it's gonna be 31,500 plus 6,250, 37,750, 37,750 minus 4,750. Cash paid to creditor 33,000. 33,000. Then you can say here cash purchase and payment to creditor 33,000. 33,000. Okay. Then next, that is done. Operating expense also done. Depreciation expense, okay. Then next, interest expense paid 6,000. You can record here interest expense paid 6,000. And income tax expense is given as 3,500. Then you can find the income tax paid amount. Okay, you can record the income tax account. Income tax. Opening balance of income tax payable is 1,250. Closing balance BCD is 850. Income tax for the year amount is only given. Income tax for the year amount is given as 3,500. Then when you balance off, you can find out how much is the income tax paid. So 3,500 plus 1,250, that is 4,750. 4,750 minus 850, that is 3,900. So you can say here income tax paid 3,900. 3,900. Okay. Then next, moving on to the fourth adjustment. The machine costing 28 million stated above has been purchased from Nalin PLC on 1st of October 2024. In this respect, the company paid cash of 20,000 and the company issued ordinary shares where the machine, which machine are they talking about? The machine costing 28 million stated above has been purchased from Nalin PLC on 1st of October. Okay. This purchase of machine 28,000. They're talking about this. In this respect, the company paid cash of 20 million and the company issued ordinary shares to Nalin PLC on the same day to settle the balance amount. Okay. So to buy this machine of 28 million, they gave 20,000 cash to Nalin and 8,000 worth ordinary share. Then under investing activity, you're going to say purchase of machine. How much went in cash? Only 20,000. 20,000. That is what you're going to say. Okay. Out of that, the remaining 8,000 is a share issue to Nalin. Okay. The issue of 25,000 or 25 million ordinary shares stated above consists of the following. So 12,000 are capitalization of retained earnings and 8,000 we issued shares to Nalin. So out of 25,000, how much are we actually getting in cash from the share issue? 12,000 is going as capitalization of reserve, that is free shares, and 8,000 shares are given to Nalin. Then how much shares are we getting cash for? Only 5,000. So in financing activity, you can say share issue 5,000. 5,000. Then a public issue of, okay, for the public issue only you're getting cash 5,000. The dividend for the ordinary shareholders of rupees 3 million stated above has been calculated as follows. Interim dividend paid to ordinary shareholder is a financing activity. Dividend paid 2,500. Proposed dividend we are not recording. Dividend received is an investing activity. Dividend received 1,000. Okay. What else is there to record? Interest expense, okay. Income tax, okay. Cash paid for the investment in share. So your purchase of shares is an investing activity, 12,000. Okay. Purchase of machine done, issue of ordinary share adjusted, dividend for ordinary shares adjusted. Now you can find the final answer. So cash generated from operating activity, that will be 36,500 plus 33,750 minus 33,000. Wait. 36,500 plus this is 32,750 minus 33,000 minus 4,600. Here it's 31,650. 31,650. Okay, here remember this is 32,750, this is 33,000. And from that, if you deduct the income tax 3,900 and interest expense 6,000, you'll get net cash flow generated from operating activity 21,750. Okay. Then investing activity, that's gonna be 12,000 plus 1,000 minus 20,000 minus 7,000. Okay. Our purchase of shares is minus next. Then my 1,000 minus 32,000, that is minus 31,000. And then financing activity, finally, that's gonna be 2,500. Then net cash flows, the total decrease in net cash flow will be 21,750 minus 31,000 plus 2,500, that is minus 6,750. Sorry, wait, I wrote it in the wrong column. Okay. Here it should be 31,000 here minus 31,000 here, 2,500. Then the next decrease in cash and cash equivalent 21,750 minus 31,000 plus 2,500, that is minus 6,750. Opening cash and cash equivalent is 1,100. So if you add 1,100 to minus 6,750, you're getting minus 5,750. Minus 5,750. Sorry. Minus 6,650. You're getting the correct closing balance. That means you have recorded everything properly. Okay. And yeah, I'm sorry for the mistakes I made in the beginning. I didn't, because I didn't read I took the cost of sale as the sale value. That's what mistakenly everything I had to cut here. Hope that was clear. Okay. Then that is done. Then finally moving on to the last part, the marginal costing question. The United Sports Club is planning to hold a ceremony to celebrate its 50th anniversary in the month of January 2026 with the participation of 8 special invitees. This sports club consists of 75 members. Estimated cost for the following ceremony are as follows. Now they have given some cost, additional information. And okay, first requirement is to find the total fixed cost. Total fixed cost. The sports club has decided to give a souvenir to every special invitee. All the members participating in the ceremony are entitled to receive a souvenir and t-shirt. It is decided to charge a fee of 6,000. Okay. Sound system hiring cost. That is a fixed cost. Sound system hiring cost 18,000. Garlands to special invitees. Garland the flowers to special invitees 8,000. Decoration 20,000. Decoration 20,000. Hall charges 12,000. Hall charges 12,000. Cost of dancing group. The dancing group 11,500. Water bottles for the ceremony. Water bottles total, it's a fixed cost. Water bottle 2,500. Now read the additional information to figure out if there is any other fixed cost. The sports club have decided to give a souvenir for each special invitee. Remember, special invitees cost are fixed cost. Okay, because there is only a fixed number of special invitees that are coming. 8 special invitees are coming. Okay, the variable costs are related to the members. 8 special invitees are coming. If we are giving souvenirs for them also, that will be a fixed cost. 8 into 1000, that is 8,000. Okay, you will be giving a souvenir for them also. Souvenir 8,000. Then you can get the total fixed cost as 18,000 plus 8,000 plus 20,000 plus 12,000 plus 11,500 plus 2,500 plus 8,000, that is total fixed cost 80,000. Then second one, variable cost per member. I'll write it here. The variable cost per member will be all the members participating in the ceremony are entitled to receive a souvenir and a t-shirt. Okay. Cost of a souvenir. Every member will get that. Cost of souvenir 1,000. Then cost of a drink bottle. Drink bottle 400. Food pack food pack food pack was food pack was 1,100. And then cost of a t-shirt 1,500. Then variable cost per member will be that in per member, right? Variable cost per member 1,000 plus 400 plus 1,100 plus 1,500, that is 4,000 rupees. 4,000 rupees 80,000. Okay. Then next, third one, contribution per member. Third one, contribution per member equals to selling price of a ticket. What are they having a ticket? It is decided to charge a fee of 6,000 from each member. You can say fee per member 6,000 minus variable cost per member 4,000. You can get contribution per member 2,000. Contribution per member 2,000. Okay. Then fourth one, number of members required to participate in the ceremony to cover the total cost. They are asking for the BEP. BEP in unit equal to total fixed cost divided by contribution per member. Total fixed cost is 80,000 divided by contribution per member is 2,000. Then you can get the break-even point in units as 80,000 divided by 2,000, that is 40 members. Now, for you to come to a situation where you're covering your total cost without a profit or loss, at least 40 members should attend the ceremony. Then the fifth one, the expected surplus if 60 members participate. So then you can use surplus. Surplus, you can say the profit to surplus equal to, you all say surplus, total contribution minus total fixed cost. Now contribution is 60 people participate. Now 1% contribution is 2,000 for one member. If 60 members participate, 2,000 into 60, that will be 120,000 minus total fixed cost 80,000, surplus will be 40,000 rupees. 40,000 if 60 members participate. Then the sixth one, the number of members required to participate to cover the total cost of the ceremony if a sponsorship is received for the souvenir given to special invitee. If a sponsorship is received, that means you don't have to incur this 8,000. Okay, then your total fixed cost. Now they're asking what is the BEP, right? How much members should join to cover the total cost? If the souvenir of special invitees only are sponsored, then the new BEP will be, okay, sixth one, break even point will be equal to total fixed cost divided by contribution per member. Total fixed cost now will be 80,000 minus this 8,000, that is 72,000. Contribution per unit is 2,000. Then now how many members should participate? Now 36 members should participate for you to break even, for you to come to a situation of no profit or loss to cover your total cost. Okay. Then the last one, the fee to be charged from each member to cover the total cost of the ceremony if a donation of 20,000 is received and 50 members participate in the ceremony. Okay. Now here we need to find out if we are getting a donation of 20,000 and if 50 members are participating, for us to cover our total cost, okay, where we are not going to earn any profit or loss, how much should we charge from each member? Okay, firstly we'll find our total cost. Okay, the total fixed cost. Now you can forget the sixth one. Okay, you can forget the sixth one because these are if scenarios. No, yeah, if a sponsorship. Now you forget about this and come to this one. Seventh one, your total fixed cost. Okay, total fixed cost is 80,000, right? Now you are receiving a donation of 20,000. Now using that donation, you can cover a fixed cost. A minus donation 20,000 you can cover from this, and then another 60,000 only remaining to be covered. Okay. Then next, how much will be your total variable cost? Okay. 50 members are participating. Multiplied by the variable cost for one member is 4,000. The variable cost will be 4,000 multiplied by 50, that is 200,000. 200,000. Then your total cost is 260,000 if you deducted donation. Now what you want to know, how much you want to charge from one member if you want to cover this total cost. Simply the fee to be charged will be total cost divided by number of members who are participating. Total cost is 260,000. We are expecting 50 members. Then how much should we charge from one person to cover our total cost? That is rupees 5,200 per member. Okay, this is the answer. So this was an easy cost. Only thing is, if you didn't figure out that the souvenirs are given to the invitees also, you will mess up everything. If you figure that out, it will be a very easy question. Okay, so then that is the 2025 A-level paper. It is done.